So we're ready to call the meeting to order. This is the City of Las Vegas Investment Committee, March 13th, 2014, meeting here at City Hall. And the first item on the agenda is there are no consent items, so the first item on the agenda is to approve the third quarter 2013 meeting minutes. I believe a copy's been distributed.
Okay. I did not receive them. Not that I'm on the committee, but we still.
I guess we want to take a few minutes to review those.
Sure.
Okay. So are there any questions on the minutes, any comments? If not, I'll make a motion that they be approved. We need more time. Okay, so we make a motion that to approve the third quarter 2013 minute meetings. All those in favor?
Aye.
I'll say aye.
I wasn't there, so I'll abstain.
Yeah.
Okay, well, I'll abstain, because I wasn't there either, so I guess I'm abstaining. So just.
I wasn't
in
there.
Okay.
It'll be the two of
Just the
us.
two of you guys, okay. Those that were present, two approved.
And to that, I'm sorry, if you don't mind, Vice Chair Appleyard. And the other, okay, and I'm sorry, could you identify yourself?
Rusty McAllister.
Thank you. Thank you.
With that, the next item on the agenda is for Freddie Sarno to lead the review of the plan, and I'll turn it over to Freddie.
Thank you. I want to start by saying I'm very happy to be back with you all today. I think we had a very productive meeting last quarter, and we're here to make the plan the best it can be for the participants. And how do we do that? We try to have best in class and the right number of investment choices. We try to minimize the plan expenses, and we try to offer the participants the best in plan design. So that's why we're here. And Dan and I worked on an agenda and sent it forward. It's on the left of your packet. And if anybody would like to have anything in the agenda that is of particular interest to any of the committee members, please let me know and we can include it now. If not, then we'll get started. Okay? Okay, so we're going to start with the, excuse me.
Starting with ICMA.
ICMA, yes.
Want me to go get Sean and Ornella?
Oh, yeah, you certainly can.
While he's doing that, Julie Hiddle, for the record, I want to make sure that we get my last name corrected to be spelled Hiddle, H-I-T-T-L-E.
H-I-T-T-L-E.
That's correct.
Good afternoon, everyone.
Hey, Sean?
Fred?
Go ahead, have a seat here.
You sure? Okay. How's everybody doing today?
Good, good.
All right.
And so I'll start with the capital market commentary. It's on tab 1, and I'll read you a synopsis of it. In the fourth quarter, despite investor anxiety over the Federal Reserve's quantitative ease 3, QE3 tapering, as well as fiscal concerns on Washington, China, Europe, U.S. equities hit record highs. QE3 allows the Federal Reserve to purchase billions of dollars in mortgage-backed securities to lower long-term interest rates to stimulate housing and other sectors dependent on borrowing. Investors appeared unmoved by the Fed's December announcement that it will reduce the bond purchase by $10 billion a month. It started with $85 billion a month. So they announced they're going to taper it by $10 billion a month. Consequently, for the fourth quarter, according to preliminary data, the Dow Jones Industrial Average was up 10.2% for the quarter and 29.6% for the year. The NASDAQ was up 10.7% for the quarter and 38.3% for the year. And S&P 500 was up 10.5% for the quarter and 32.4% for the year. Quite a year for the stock market, 2013. All 10 sectors of the S&P 500 advanced for the fourth quarter. Industrials advanced 13.5%. Information technology was up 13.2%. Consumer discretionary was up 10.8%. The laggards were telecommunications, which was up 5.4%, and utilities, which rose 2.8%. Morgan Stanley economists expect that U.S. real GDP will expand to 1.6% in 2013. The numbers aren't out yet, but they'll be released. With a pickup of 2.6% in 2014 and 2.7% in 2015. Global GDP is expected to come in at 2.9% in 2013, picking up to 3.4% in 2014 and 3.7% in 2015. So the global economy is expected to stay on a steady course of expansion. Both value and growth stocks rose for the quarter, with growth stocks faring slightly better for large cap companies. The Russell 1000 index, as a large cap index, was up 10.2% for the quarter and 33.1% for the year. The Russell Mid Cap Index was up 8.4% for the quarter and 34.8% for the year. Wow. And then the Russell 2000, which is a small cap index, rose 8.2% for the quarter and up 34.8% for the year. In the fourth quarter, the MSCI All Country World Index was up 7.4%. Emerging markets were up 1.9% for the quarter. And for the year, the MSCI All Country World Index was up 23.4%, and emerging markets were up 23.3% for the year. In the fourth quarter, the bond market continued to incur losses. The Barclays U.S. Aggregate Bond Index, which is the general market of the bond index, declined 0.14% for the quarter. Interest rates climbed during the fourth quarter as yields on the 10-year Treasury rose to 3.02%, from a low of 2.5% in October. 2013 was a difficult year for fixed income, with the Barclays aggregate index declining 2% for the year, posting its largest annual loss since 1994. In the fourth quarter, commodities fell 1%. Gold continued its decline, dropping 9.3%, and it plunged for the year. It was down 28%, the worst loss for gold since 1981. So anyway, as stocks did amazingly well, bonds didn't do so well for the year because interest rates rose. Last night, the 10-year Treasury closed at 272. And has anybody seen the stock market today? Well, the Dow is down about 200 points today. So weak market for stocks, and what happens in the market is, money flows somewhere. And so people got scared out of the riskier investments in stocks, went into bonds, and the 10-year Treasury rallied down to 2.66% today. But anyway, a good backdrop for some very good returns that we're going to be seeing. Excuse me. On tab 2, here's the executive summary, and this is new from our last meeting because we had put some different funds on watch, and from last meeting, here are the funds that are on watch that we'll be, taking a better look at. In large value, Allianz. Large growth, you've got Calvert. Mid-cap is the Goldman Sachs. Small blend, T. Rowe Price. Mid-cap growth is a Vantage Point, and then the bond index, and then within large growth, you've got Vantage Point T. If you go to page 10, here are the number of funds that are within the plan with ICMA. And there's a total of 40 funds. This is what I call the 30,000-foot view level looking down. And, I'll remind the committee that as we get kind of down the road with looking at performance, you might also start considering, if it's a direction this committee wants to head, is ways we can maybe consolidate and weed out some of these funds, more than one fund in every category.
If I can make a comment on that, I was
Yes.
looking at my balances the other day on the computer when I finally logged in. The amount of funds we have is absurd. To try to compare performance throughout all these funds is like next to impossible to make a rational decision.
Well,
In my opinion, anyway. I mean, just the consolidation of like the target date funds have a specific purpose, but the amount of equity funds we have, it makes it very, very difficult to come to a rational allocation to various funds without driving yourself crazy comparing 3, 5, 10-year terms, and one does better 10-year, one does better 5-year. It's a paralysis by analysis for myself, but that's just some of my thoughts.
Rusty, what do you think?
I agree that we need to look at the amount of funds. Do I believe that within the categories that we offer that we should have at least a choice? Probably. I mean,
Yeah.
if you're just given them one choice, that's not a choice. So within each category, a minimum of 2 within each category. Some of those categories we have 4, 5, 6 funds
Yeah, exactly.
that you can choose from. And as we looked at last time, and I think you guys have, from the looks of it, you guys have replaced a lot of funds and done a lot of stuff. This is the last meeting. We had so many funds that were sitting in the bottom 50% of returns, and they're still on the fund for a significant amount of time. And so the question is, are those the ones that need to somehow get molded into something else or moved? I don't know.
All good,
Sort of
all
things.
good questions and good input, and I'm glad to hear you say that. It's been my personal opinion that it's certainly the way to go.
Julie Sheldon, for the record, I would like to say that you need to take into consideration, I deal with 1,257 people, that their comment back to that is going to be, I don't want to be told what I can invest my money in. Okay? So I'm very concerned at telling people that have certain plans and have certain things, if this committee goes and starts cutting them, and they're going to say, well, why? That's my choice. It's my money. the city's not contributing to my contribution to this, so why am I not able to have the choices that I want to have? So I'm concerned about that because just based off of my 1,257 members, trust me when I tell you, that is the response that we're going to have. If we go cutting things out where that they can't have the options.
Edward O'Neill, for the record. They are being told what they can choose with the number that they have now. There are many, many, many more choices that they could be choosing from that have been pared down from all of the choices that are available to us worldwide. So I understand what you're saying, and I am referring to that comment of being told what to do. They're not being told what to do. We are trying to give them better options and better returns and better funds that they could choose from. And I think that's what our task is. It's not going to be an easy one. It's always going to be difficult. And there's always going to be hard choices that need to be made.
I agree with those comments, Freddie, and this is Rusty McAllister again. With regards to, at a bare minimum, if you don't eliminate funds, at a bare minimum, you need to let your members know that for the last 3 years and 5 years, these funds have been in the bottom 50%, and in many cases, they were in the bottom 75% of funds. We need to let our members know that when they look at the fund chart that comes out to their work location, or they see it online when they log in, they don't see what percentile they're in. What they see is this fund had a 3.5% rate of return for the last 12 months or 5 years or whatever. And what they don't know is that 3.5% is in the bottom 75 percentile of all the other funds that they could have been in. So at a minimum, educational process with our members, knowing that even though you made 3.5% on your money, you could have, because you're in the bottom 75 percentile, you could have made, 6-7% on your money. Just as an educational process.
Julie hit on. I agree with that, but it's going to be about education. We can't just unilaterally start cutting out things and expect them to understand, because when they wanted to get rid of one of the programs completely, our entire membership went crazy.
Yeah.
And in my membership, the membership that I represent is one of the largest bargaining units for the city. So basically, I have a lot of concerns about how we go about doing that and the educational process that needs to go along with it to explain why we're doing what we're doing.
Yeah, all very good comments and a lot of good input, and I think that, you got to strike the right balance. But, remember, whatever decisions come out of this is that, the reason why this committee is being formed and the responsibility of, signed on to as a fiduciary is to make high-level decisions that, people with not as much information can't make for themselves. And through the process, you weed out, if somebody is in, the XYZ fund and they like it, but they don't know it's in the top or the bottom, 80th percentile, you're doing a favor by, mapping their money into a better fund. They're just not aware of it because they don't have the information we have. And then, required notices are sent out by ICMA, the record keeper, we move this fund, better performance, blah, 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 and the communication sent required. So, it's a delicate process, but I think just know that a decision we make, it's the prudent man rule, acting, for the right thing for somebody that doesn't have, can't do it themselves.
This is Dan Regato. Julie, we've made changes to funds in the past, and we've mapped from Fund A to Fund B. And I didn't receive any phone calls. However, to your point, education is paramount. Absolutely. Everybody needs to be better trained in how deferred comp works. Can't argue with that at all, because if they understood what was going on in the market and how we did our analysis, they should be relieved that we're making these changes on your behalf. But we have to educate them on that first.
It's all about their, but Julie hit it again, but it's all about their choices to do with their money, how they choose to do with it. And I have to tell you, our office received, when they were getting rid of the Mass Mutual, when that was brought up, we had 857 phone calls. How dare they? So, you know what I mean? So I'm trying to tell you, I know based off of my membership, the kind of response that we're going to have with regards to starting to unilaterally make a lot of, even though it may be the right decisions, and I'm not disagreeing that it may be in the best interest, it's just about doing it the proper way with these people, because it's not going to make any difference. You're taking this away from me, why?
And just to clarify, Russ McCallish, I'm not suggesting that we take away a plan administrator. I'm talking plans or
Right.
funds within the
Yeah.
plan.
Right.
Which is what.
Which is, certainly I'm not trying to, or don't want to see any of the funds taken away, but I want to see possibly the reduction of the amount of funds that are offered within certain categories
Right.
Yeah.
of investment
And
class.
to that point, I think maybe this is something to consider, a way to serve both interests, both concerns, is that if you have 3 funds in a category and one is kind of a stinker, let's say, instead of replacing that with another fund, you can take those and map it into one of the two, and that's could be a happy medium.
Right. I'm just saying, I know what I deal with every single day. And being as the fact that I represent the largest bargaining unit for the city, I know what I'm going to be dealing with if we start making all these things where we're going to make this go away or this go away, and people are in them and they're not going to understand. So it's 100% going to be about the education of why this happened,
For sure.
and the backup documentation to show it, because it's all about show me why you're making this decision. So it's concerning.
Good comments.
Vanessa, I just wanted to add to this. I really think it's going to be better for them in the long run to have, they still have choices. They're still going to have choices, but they're going to have the higher level
Right.
funds to make those choices between. I think they'll appreciate, if we educate,
Yeah.
that we're, as you said, to eliminate the ones that aren't performing well.
Right.
So
Right.
I think choice is there. It's just doesn't have to be so big.
Especially when 6 of the 8 of the growth stock funds, which I would hope some people have some percentage of their 401k are self-sustainable. That's a bit of a concern.
Okay, so if there's no other comments on the general discussion of consolidation, we can move on to page 11, plan summary. And again, this is in the context of the 40 funds, how many are doing well. And, this talks about, for the quarter, because we're looking at quarterly performance, remember, we're evaluating in a bigger picture, we're evaluating funds over a 3 and 5 year market cycle. But of the 40, 15 funds were in the top quartile, 4 funds were in the top third, 8 funds in the top half. So that's 27 that are generally good, at least for our investment policy guidelines. 12 in the lower half and 5 in the bottom quartile. Not so good. Down below the fund highlights, we've got some real superstars here. Calvert Equity A. Now remember, I talked about large cap growth being one of the best categories. So Calvert Equity A, top performer, up 12.21% in the top 9% of its category. Hero Price Growth Stock, again another large growth fund, up 11.9%, the top 13th percentile. Times Square Mid Cap Growth, up 11.41 in the top 3%. That's a superstar fund. Fidelity Puritan ranked in the top 8% of its category. Fidelity Diversified International, top 8 percentile. And Vantage Point, the 2045 is a target date fund in the top 10 percentile. Fantastic.
This is just for the
quarter.
For the quarter.
Yeah. Okay, so on page 13, this is the plan composition that equals $45,520,242. And you can see, again, just kind of back to the general topic of of, some consolidation, and when you look at the balanced conservative category, we've got, 3.9 million in the Vantage Point, Fidelity Puritan, 277,000, less than 1%. There's opportunities. On the second page, when you look under the large value, with only 53,000 in that Invesco diversified, it's not getting a whole lot of sponsorship. So, these are situations where you can compare the two and maybe consider some consolidation. And then again, in the large blend, with only 53,000 in Oppenheimer, that's an obvious opportunity to, weed out some of the funds that aren't, really attracting much attention to begin with. Now, I'll bring your attention to, when you look at this, there's a number of funds with a zero balance. Those are the funds that were transferred and mapped into new funds last quarter by ICMA. Just want to bring that to everyone's attention if you're wondering why there's a fund with a zero balance. Okay.
Just as a side note, real quick, while you're doing this, just have to. It's kind of interesting though when you talk about, Calvert Equity A. There's only $26,000 there. Maybe it's a good opportunity to move something, and you just got to reading to us the Calvert Equity A was the top performer, 12.4%.
I know.
12.21 for the fourth quarter, ranked in the top 9% of the Morningstar category.
No, I'm aware of that. So, maybe you keep it and move the $1.4 million in Fidelity into that fund. It's a fair observation. But yeah, you're right.
But it's still on the watch list.
Yeah.
I mean, one.
Because of its long term.
Yeah, one quarter.
Yeah.
One quarter does not make
not
3
a
years.
fund manager.
One sunny day doesn't make a summer.
Exactly.
Yeah. Yeah. Okay. And then on page 15, you can see in mid-cap growth, you've got the Rainier and Royce was mapped into the Times Square. And then on page 17, what I'll point out is under stable value, you've got the Vantage Trust Plus, 13.4 million, about 29.5%, which is not a problem. It's fine. If you go to page 20, here's just reminding everybody of, as we look at the watch list and look at the performance against our investment policy criteria, we want the funds to be in the top 50th percentile over a 3 and 5 year annualized period. And the scorecard section is okay, but what I would take you to is if you go to page 27, I think a little better use of time is if you look at the scorecard detail.
Okay, that's what we're looking for.
Yeah, on page 27, and this is going to bring the attention the funds that are on watch. And you've got this Vantage Point in inflation protected bond fund, 53rd and 52 respectively. Last quarter, over a 3-year period, it was in the 60th, so it improved a little bit on the 3-year. And over a 5-year period, it was in the 36th, and it got worse on the 5-year. The investment policy has a hedge because it says there's no hard and fast rules for replacement, and the committee might consider keeping this on watch. You don't have to be trigger happy. You can give it a couple quarters, look for trends, and then take action. Vantage Point core bond index, you see the 76th and 88th respectively. This has been on watch. Last quarter, for the 3-year, it was 79th, so it got a little better. And on the 5-year, it was 84th and got a little worse. So it's still not doing very well, ranking-wise. Then you got the PIMCO, excuse me, I beg your pardon, committee. Let me back up as we go on, I think we should, make a decision that to, either keep it on watch for another quarter, and we can, make a motion collectively or do it fund by fund, whatever your preference is. Any comments on that?
I mean, the criteria we set last meeting, if I'm not mistaken, was any fund that has a 3-year and 5-year both in the bottom 50 percentile, we would keep we would put on the watch list.
Yeah, for a couple of quarters.
For at least a couple of quarters to see what that is going to do and see if it improves.
Right.
And I'm okay with leaving that policy in place and taking a motion at the end to confirm those funds that are still in the bottom 50 percentile in both categories, 3 and 5.
Okay.
If that works for everybody else.
Okay. So first, what I think we'll do is we'll identify and acknowledge the funds that are on watch. And then there are some funds that weren't on watch last quarter that have fallen slightly below the 50th percentile. But if you go down to the Allianz NFJ Dividend Value Fund, it was on watch, but over a 3-year period, it is in the 43rd now. Last quarter it was in the 53rd, so it got better. And it's in the 85th. It was in the 91st last quarter, so has improved a little bit.
Is there any indication of whether these were on the watch list last quarter anywhere here?
Well, it just started.
It just started
Yeah, last quarter was our first review.
Okay.
So, and on page 28, you've got that Calvert Equity A that was on watch, and we just reviewed a very good fourth quarter performance, and that quarter performance improved significantly because over a 3-year period, last quarter it was in the 84th percentile and improved to 69th on the 3-year, and it was in the 74th percentile over 5-year, improved to 60th. So that's an improving trend. And Vantage Point Growth T.
I have a question. The red box right next to the
This
fund,
red box.
like how
Oh, yeah. Those are those are Morgan Stanley's. We have a set of screening criteria that I can, come with the list, but if there's a list of either the fund manager tenure isn't 5 years, or the oldest share class of the fund isn't 5 years, or there's been a manager change, something like that, it doesn't mean that you still can't have it in the plan if it's performing well.
I mean, your company would not recommend it to your clients.
You could say that, yes. The Goldman Sachs mid-cap value, you see 69th and 63rd. Last quarter, 3-year was 68th, so it got a little bit worse. And then 62nd on the 5-year, now it's 63rd, so still struggling a bit. And then on page 29, Vantage Point Aggressive Opportunity Fund is a mid-cap growth fund. That was on watch, but lo and behold, it had a very good quarter, and last quarter, after being on 88th percentile over 3-year, it improved to 66th, and it was 52nd on the 5-year, now it's 49th. And then the T. Rowe Price small cap value was on watch, went from the 51st percentile last quarter to the 47th, which is an improvement, but it got worse on the 5-year. It was 53 last quarter, now it's 61st. So would somebody like to make a motion to keep those funds, all the funds on watch for another quarter?
I'll make a motion to keep those on watch for one quarter.
Discussion on the motion. Discussion on the motion. Mr. McAllister, so the question in my mind is, The policy that we set last quarter was if you have a fund that is on the 3-year and 5-year in the bottom 50 percentile, it's on the watch list. Now granted, one quarter does not make a fund, but are you disregarding your policy that we set last quarter of if you have a 3-year and 5-year in the bottom 50 percentile, and now they are not in the bottom 50 percentile in either one or the other of those two funds? Do we take them off the watch list, or do you leave them on the watch list based on the criteria that we had last quarter when we met and set it?
Yeah, a very good question. You know,
Because a
and
couple of these have moved off
On one
out
of
of the red line, either on one or the other.
that's correct.
So
That's correct. And I'll tell you, to, answer that, I will tell you that the first quarter, we were hearing so much, some of the funds were so glaringly not compliant because they were below on the 3 and 5 year. There were some funds at the time that were only in violation on one or the other, and the committee decided, let's just deal with the ones that are below on both as a starting point, since what we're dealing with is voluminous between the three providers. But you could go either way. I would probably encourage you right now, since we're not, the committee is not going to take action on replacing and replacing any funds, even if the fund has dropped off or gotten up above the 50% on one or the other. I still think you could keep it on watch.
might I offer a suggestion, if it's possible? I don't know, because you guys put together this report, Freddie. On this particular report where we see the number on this 3 or 4 pages that you have here, is it possible for you to put the 3-5 year, like quarter one, the quarter
The
two,
previous ranking.
the previous ranking for the last two? So if we wanted to change the policy and say if a fund is in the goes on the watch list, it stays on the watch list, say 2 quarters until it shows a consistent pattern of being out of the bottom 50 for at least 2 quarters. I don't know, something. But we'd have to have that to compare by for 2 quarters worth of time.
Yeah, and that's why
don't
I'm
know
going to
if
have to check. It's kind of a software, hardwired, but that's why I go back previous quarter, quantify where it was last year so I can report trends to the committee. And if we couldn't change it at a software level, I would keep track of 2 quarters so I could report 2 quarters of trends.
Okay.
So one way or the other, we can accomplish it.
So at least that way we can see it. I mean,
That's what I was asking
Understand.
earlier about a rolling basis instead of just a snapshot.
sure,
And here's
3 months is nothing.
I'm curious that I wouldn't want a committee, I mean, this kind of goes to Julie's point. I wouldn't want the committee to make a decision just on the pure fact that 2 consecutive quarters, if we don't, it could be 88 percentile, 3 year, 96. We don't see the numbers that we saw last quarter,
Right.
even on the ones that are on the watch list. So we do see some improvements, and I think it was said last meeting that 2008 was going to start dropping off and making a
So we're going to
difference.
start seeing these numbers
So the
drastically
numbers,
improve on the 3.
so they could still be in the red, but they could go from 88 to 52,
And prove it.
and be a big improvement.
Mhm.
Yeah.
We may want to make sure we're watching
Sure.
that, but I don't know if we want to make a hard and fast rule that says they stay on the watch list. They may be making an improvement that we even pull them off the watch list, although they may be in the lower 50 percentile after 2 or 3 quarters, and so I don't know if we want to make a hard and fast rule that is the case. I like the rule that they go on the watch list.
Yeah.
I don't know if they would come off of the watch list or even continue on the watch list just because 2 consecutive quarters they were below 50%.
There is language in the ESL policy statement that's kind of like a hedge. So we have our guidelines of top 50 percentile, but in the investment policy it states there is language that says there are no hard and fast rules to replace a fund. So there is an element of subjectivity. So generally, if it goes below a 50th percentile over 3 and 5 years, it goes on watch. If something is in the 80th percentile, and next quarter it's in the 60th, and next quarter it's in the 52nd, that's kind of a subjective reason to say, this fund is making some really good movement. Let's keep it on extended watch, and then it gets another good quarter, it gets above the 50th, take it off watch, and that way you have a safety net under decisions. So.
Julie, I would just like to say that, given the fact that here in a few quarters, 2008 is going to fall off, I'm very hesitant about making a move to remove anything out that is even below until we see what's going to happen with 2008 once it falls off of the 5-year, because it looks to me like there's a lot of things that have significantly improved that we had on here. Maybe not in the top 50 percentile, but they've made significant improvement from where they were back in December. So for me, the ones that made the improvements, I don't even know that we need to keep them on the watch list. We didn't have anything with, they had the one, if they had one that was they were okay in the 3-year or one that they were okay in the 5-year, we didn't even put them on the watch list the last time. Some of those have gotten better. And so my question would be, why don't we go ahead and remove those that have gotten better off of the watch list that are in one of the categories that are above the 50 percentile, and keep with our what we had set to have just the ones that were both underperforming under the 50 percentile be on the watch list for the next quarter, because at least that way we're going to really be able to see what is the trend. Are they going to continue to improve? Are they not? Based off of the software that you've got going on with this right here. I think that it would.
So you're saying if a fund was on watch, out of compliance on 3 and 5, if one of them improves so it's above 50th,
Right.
on one of them, take it off watch?
Take it off the watch, because that was the criteria that we used when we put them on watch. They were, both numbers were below 50%.
The opposite of that, though, is if you were to remove them off the watch list, we have some funds that actually dropped in from where they were at last month. They improved in the 3-year, but dropped actually lower in the 5-year. So I don't have a problem with leaving them on for more than just one quarter to get a vision of what's happening.
My thought was that if we left them on the watch list, because since we've only had one quarter to do this anyway, it might be more educational for us to see 2 quarters or to be watching on the watch list. So that's kind of.
I think we're going to find a lot of these are going to improve
Yeah.
once 2008 falls off.
Yeah, I think if you look at this, what we're trying to accomplish on the wide scope, big picture, there's so much. It's a long road ahead of us. It's a very new committee, and I think it's a generally good idea to keep things on watch. Not make any, trigger finger decisions. Let's say, keep the ones that are on watch, and just like you said, let the 5-year, let 08 drop off, and kind of settle into what we're doing a little bit here. Get comfortable with this over a couple meetings. Come back and have a little better vision of, and then maybe have some action items.
And
Yes, we keep all the funds on watch, and continue to watch the watch.
Absolutely.
as opposed to the 5-year rates of return, Freddie, I'm more concerned with the 3-year rate of return. The 5-year return still has 2008 on it, or the end of that dump off. But the 3-year rate of return is since 2011.
Yeah.
We've had a good 3 years.
Amazing.
This market's been doing. I know in PERS where we've averaged over 12, and 1 year out of the last 3 we had 21% return. So the 3-year rate of return, because the market has done very well over the last 3 years. Those are the funds that would concern me if they're still in the 70, 74 percentile in over 3 years when everybody's been making money.
Yeah.
Does that make
Can I
sense?
make an observation on the U.S. equity on page 28? Whereas there's the 500 stock index and the broad market index, 2938 and 28 and 22.
I'm sorry.
The the Vantage Point
Yes.
500 stock index.
Yeah.
So let's look at the broad market index. So over a 5-year period, the index beat 78% of the actively managed funds. Is that correct?
And other index funds.
And under.
Yeah, all funds in the whole category.
So the computer is better than 78% of the investment managers.
Typically.
Yeah, usually.
Typically only about, in
It's
any
just an
given year,
it's just an-
25%.
It's
yeah.
just an observation.
No,
Yeah.
Only about 25%
it's
in
very
a given
difficult to
year.
beat the market, that's why.
Yeah,
That's
exactly.
why people, that's why there's, some people will do an index fund only strategy using that the market is efficient, so we just invest in the market.
It's just interesting that you don't see many index funds on this list on the watch list.
You can't, well, you really can't, if you think about it, unless it's very poorly managed, unless it's very poorly managed.
It really can't be. It'd have to be, at worst, be 50, probably.
I would like to bring attention to some funds of the committee that were not on watch, that are now below the 50th percentile. On page 27, there's the Vantage Point Inflation Protected Bond Fund. It went last quarter from 60th to 53rd, so it's a little better, but on the 5-year, it went from 36th to 52nd. So it's the Vantage Point Inflation Protected Bond Fund, the first fund on page 27. So that fund would be a consideration to be on watch. The PIMCO High Yield Fund was not on watch. The Vantage Point Model Portfolio Traditional Growth was not on watch.
What are you comparing this to? What, to January and February performance? Or?
Well,
Which one did you just say?
These
yes.
are as of December 31st, so what's...
Well, we're looking at the fourth quarter.
September 30th.
What was on the watch
So this
list?
is as of December 31st.
Yeah,
Oh, so you're reviewing it.
we're reviewing it. This is the fourth quarter review.
Correct.
And
So
I'm just looking
what
at
numbers are
returns.
you looking at?
The rankings that I was telling you were the rankings for the third.
Oh, the third quarter.
Yeah.
Oh, okay.
Yeah.
Yeah, well, okay. That one. I'm still looking at the right
So again, on page 27, the first fund is below the 50th on 3 and 5 year. And then the Vantage Point model portfolio under the balanced asset allocation is below the 50th percentile on 3 and 5 year.
Which one are you looking at, Freddie, on page 27?
On page 27, the first fund, Vantage
Vantage
Point
Point
inflation.
Inflation Protection.
Yep.
Yeah.
And then under the balanced asset allocation, the Vantage Point model portfolio traditional growth.
Traditional growth.
Yeah.
Got it.
I think I'm getting confused. I thought this meant they were on the watch list.
No, that's a fund that would not screen and be approved by
Oh.
Morgan Stanley.
Oh, I thought
Yeah.
that was this guy.
Yeah.
Okay, and I thought
What's
this
the big
was watch
exclamation
list.
point mean then?
Yeah, I
Yeah.
thought that meant it was that.
Yeah, it
watch
means,
list. Sorry.
yeah,
Okay,
there's
and I have a question, Freddie, because according to the books from last month,
yes.
or from December, that one was on the watch list.
Which one?
The one that you just said it was not.
Vantage Point.
The Vantage Point Model Port Traditional,
growth.
it was on the watch list. We put it on the watch list.
Oh,
Because
oh.
it was 56th and 53rd in December.
You know what, Julie? Thank you. And Sean, can I please clarify? That portfolio, is that part of a suite of
Yes.
the risk-based funds on? Okay. Thank you, Julie. Let me clarify. Originally, we had talked about that fund being on watch. Is that what you're suggesting?
No. We put it on the watch list because right here
It
is
should
my
have been on the
right here is my books from December's meeting,
Right. Okay.
and that was one of the funds that we put on the watch list.
You're talking about the model portfolio traditional growth.
Yes.
Okay.
That's correct.
Yes, and that was put on the watch list in error because when I realized that fund is part of a group of funds within the Vantage Point funds that are the asset allocation funds, the conservative, moderate growth, aggressive growth. They kind of come as a set. Is that right, Sean?
You are correct.
Yeah, so when you look at the suite of those funds, they're mostly good and performing. So that fund actually should not have been on watch. Okay,
It's,
and I apologize.
Well, no,
Yeah.
Julie hit on it, and I beg to differ, because there's like two of the three of them that look to be like grouped together here, aren't performing well, according to what I'm looking at here. So I don't understand why you're gonna say
if
that.
I could just interject real quick, and I'm not here, actually, I'm not a proponent of any of the funds. You guys are more than welcome to do what you want. So I don't have any skin in the game per se, even though this is our investment lineup. One of the things you're going to find with the model portfolios is that they have a very heavily bond orientation, especially in the savings-oriented, conservative, and traditional. When you stack that up against the index, which is kind of what Freddie was referring to when you talk about this week, they're very conservative. So when the market's going up and the stocks are going up, the bonds become a lag. Hence you end up with underperformance. Conversely, if we were in a down market, the bonds would help to keep them up, and you'd see a flip-flop. So when you have, as Rusty was pointing out, a period where you have 3-4 years of great growth, the bonds become a drag, so it looks like the performance is a drag, when overall, as a suite of funds, they actually perform very well.
Yeah, and let me bring some to your attention, Julie. When you look on page 27, under the balanced asset allocation category, there's conservative allocation, moderate, and aggressive. You see that? And if you look at those vantage point, the conservative 35 and 58, so not horrible. The model, the traditional growth, that's the one I was referring to that is below the 50th. Then you look at the aggressive one, the model portfolio, long-term growth, 33 and 50, so pretty good. So that's the one that is not as good as the other.
Well, I guess then the reason I'm bringing up what I'm bringing up is because looking at what was in December,
Yeah.
the aggressive one was 38 and 36, and it's now 33 and 50. So I guess when you're sitting here looking at what I'm looking at, I don't understand how you're saying that it's okay, because it did change a lot. This one up here in the top line of that, it went up, it dropped on the 5-year even further. And the other two dropped one but went down on the 5-year, and then this one right here. So I'm looking at the numbers. So I don't see where we're saying, oh, this is doing great when it was 38 and 36 on the aggressive allocation, and now it's 33 and 50.
Okay, I'm a little lost here on
How do
what are
we-
you trying to point
How
out
do you
here?
understand the group?
Baker.
They're all
Yeah,
evaluated against
Okay,
something.
this is what it was in
So
December.
this is
This is from
the
December.
aggressive growth. Okay,
So it was 38 and 36,
okay,
and now it's 33 and 50.
right. Okay,
This right here changed, and this right here changed.
The aggressive can have more stocks.
okay.
So do you understand what I'm saying? I'm looking at the overall, because I'm looking at last quarter what it was
Okay.
and what it is right now currently. So this got way worse.
No, I know, but that's okay. This got worse. Okay, yes. Okay, but it's still, this is good. That's median. So it got a little. It's not
I guess
poor.
what I'm really saying is this particular one right here,
Fidelity Curate.
it seems to be the only one in the whole package that's doing well. That's my point.
Well, that's your point.
Yes,
Okay.
that's my point.
Well, then we got to improve these funds. Okay. Okay, in any event, would somebody like to make a motion to put the Vantage Point inflation protected
I think
bond
there's a motion
fund?
on the table.
Is there a motion on the table?
Ed O'Neill did.
Oh,
He had a motion to keep all the funds currently on watch.
yes.
And,
Do we have to have seconds?
yeah, when we had a second.
Then-
Freddie, are those the only two additional funds that you recommend that we need to move to the watch list?
The Vantage Point inflation protected, I
Yes.
would put on watch.
Uh-huh. And the PIMCO high yield and admin? I believe you said that was not on,
Yes, that's correct.
that was not on the watch last
Yes.
quarter. Okay. And I'm wondering on the other pages, are there others that you recommend adding on? If there are, then
No,
we could take one motion. Okay,
no.
then I think you already made one.
So we're saying any fund that has a red box in the 3 or 5 year return will remain on the watch list. Is that
Yes, and the new funds that are on watch will be the inflation protected bond fund, the Vantage Point inflation protected bond fund, and the PIMCO high yield admin.
Where's the watch list?
I'm on page 27.
Okay.
The complete watch list?
Well, the watch list is from funds that were on watch from last quarter. Okay, that's what's on page
In our binder.
8. That's what's on page 8.
Okay.
These are on from last quarter. Okay,
That's what I was asking.
but now we're adding. Is there a motion to add the Advantage inflation protected bond fund and the PIMCO high yield to the watch list?
You made a
Make
motion
that
already.
amendment.
Okay.
Okay,
And I second the motion.
great.
Oh, I got it. Yes.
Okay, now, if you want to look at the performance of the funds, the absolute performance against, benchmarks and rankings, they start on page 35.
Are you
And-
on page 10, I'm sorry?
Yes.
Where it has the little upside down triangle with the exclamation point?
Yeah.
It says fund does not meet minimum passing score. Is that the watch list passing score or Morgan Stanley passing score?
Both.
Okay. There could be a fund in there that doesn't meet Morgan Stanley but is not on the watch list?
No, if it's on the watch list, it's going to come up with,
With the-
yes,
The
yes,
exclamation.
yes,
Okay. And some of those funds may not meet Morgan Stanley's
that's
recommendation.
correct.
Okay, then that leads to another question, because some of these things that have question marks on them for doesn't meet minimum passing score weren't on the watch list last time. So are we adding them to the watch list, or are we not adding them to the watch list? Because the Fidelity Contra Fund.
No, we are not.
Okay, I just want to make sure.
This question mark here means, when it says that means they just don't meet a criteria that Morgan Stanley sets for funds.
Okay.
But it doesn't mean that it doesn't meet the criteria for what
That's correct.
they have
Okay,
on
because
offer.
that's the question he just
They're not
asked,
fun.
and he said if they had the question marks, that it was on the watch list. Isn't that what you just
I said everything with an exclamation point on page 10 is
On
on the
page
watch
10.
list. Is that correct? Or-
No, no, it's not. It's not.
No.
Because he just got done saying that wasn't. So that's what I'm saying. No, it's not.
Page 10, is that
Page
mean every,
Page 8 has a.
Juliet, let's try to answer your question. What is the question?
No, it's not me, it's his question.
is every fund with an exclamation point on page 10 on the watch list now, or recommended to be on the watch list at the end of this meeting?
No.
No.
That question mark there, if I'm not mistaken, Freddie, is purely a Morgan Stanley.
No, I thought that was a little box, the little red box.
Yeah, it does not meet minimum passing score. You see on page 28?
Yes.
Yes, that is, that's a Morgan Stanley screening criteria.
So we only
It
have.
happens to coincide with everyone that has a red box.
Okay, excuse me, it's Morgan Stanley's and the investment policy criteria we set, which is 3 and 5 year, okay? So just because it has a red box, sorry, John,
Okay.
if it has a red box on page 10, it doesn't mean it's on the watch list, because we only put funds on the watch list that are under the 50th percentile for 3 and 5 years.
That have, 3 and 5.
Yes.
Okay.
Okay, and I want to remind you that of the 102 funds across 3 providers, we put about 32 of them on watch. If we put it on, impose the criteria on 3 and 5 year, we should, it's a tear down and rebuild for the whole deferred cost. So,
Well, that's what I was worried about. I think we're going to turn through funds if we
Yeah.
keep people off for having one red box. I mean, we'll all be in index funds, basically.
It'll play out, this is only your second meeting as Freddie pointed out. It'll play out over time. I've been at 100 of these meetings. And as you go, you'll see some will pop up, they'll go off. And we fortunately, before the last meeting, the number of the funds Freddie was going to address that were more critical, we had already been addressing them because of chronic long-term underperformance. or management change. I mean, and there's a number of reasons. I don't want to give you just say chronic underperformance. It could have been any number of a dozen reasons why we took care of it.
Right. Okay, so on page 35, this is the performance of every single fund compared to the fund category and the benchmark, and it has the 1, 3, and 5-year ranking. I've gone through this, line by line and have my notes, and if anybody wants to, review this, we certainly can. Suffice it to say, the funds that should be, that you should have a concern about have been identified on our watch list.
This doesn't have the deviation from the index listed, right?
That's on another section,
Okay.
standard deviation and beta.
Oh, I see, okay.
Yeah.
There's the large, okay, I see.
Yeah.
I see. Sorry.
Yeah. There's another section that has the risk measures, though.
Yeah.
Of beta.
No, I was actually
Yeah.
asking for, this is the index for that palette of funds.
No, large blend is a category, and Russell 1000
I'm sorry,
is the
Russell
index.
1000 is the index.
Yes.
You can just look right up. Because I was trying to do this online, and it gets very tricky trying to compare indices.
Yeah, it's tough. You need a printed copy. Yeah. Does anybody have any questions about the performance line by line of the individual funds? I can address it if you want to reference it. Like I said, I've gone through this line by line, and I can verify that performing funds that are doing fine, no reason, but the funds that are on watch, you can tell by the rankings and the performance of those. Any questions, comments about that? So we've made a motion to keep the 6 existing funds on watch. We made a motion to add 2 funds on watch, and that concludes the fund review for ICMA. And now an ICMA update.
Thank you very much, Freddie. Well, we want to be. Okay, so I'll tell you what. We'll keep it to 10 minutes. Just a quick 10 minutes to run through a couple of things. If you could hand this out. One of the things, and we kind of talked a little bit about the last time, but we were running long again as well. What we wanted to do, because Freddie's handling the investments and so forth, is give you an idea of how your plan is performing as a whole. What's the growth of the plan been and so forth. So if you take a look, Ornella just handed out, we call it Plan Analytics. It's just some of the reports that I can pull down. And on the first page, you'll notice, kind of right here on the right-hand corner, you'll notice that over the last 5 years, between the highs, the lows, the ups, and the downs, with ICMA Retirement Corporation, your plan is actually returned about a 65% rate of return, which is really, really good. Last year, the market was up about 30%. Year before, it wasn't. So you annualize that up between the highs and the lows, and people are making about 10.2%. Those are people who are conservative as well as aggressive, and then everything in between. And one of the reasons that how you generate that return is in the graph. It shows you through using color coding, how people are invested. You'll notice that the blue down at the bottom, that would be our stable value, that would be our savings account. As an overall percentage of the portfolio, and I'm only addressing the 457 plan here now, it represents under 30%. So people are invested appropriately, especially for their age and so forth. Now, what I've also done on the next page, kind of like what Freddie was just showing you with the individual funds, is giving you actually a month-by-month breakdown of your entire portfolio pretty much over the last 5 years. So, for example, let's just go to right now. Market did not do well in January. It was down 1.7, or was actually down a little bit more, but your portfolio was down 1.7. We had a good February, and after today, we'll see what happens. Hopefully today was not a good day in the market, by the way, if you didn't notice it. But we'll wait to see how March does. So this kind of gives you a breakdown of how your plan as a whole is performing on a quarterly, month by month, and then also on an annual basis. If you guys as a group like this, I can continue to bring these for you as well. Just give you an idea of how we're performing as a whole. Mm-hmm. And then finally, we have been working with Dan and Freddie, and we've been talking a lot about, and Julie couldn't agree with you more, education is critical. Fortunately, a lot of times when it comes to investments, they'll sit down with Ornella or the representative. People generally tend to self-select. I mean, occasionally you have funds that are underperformers that might have a large amount of money, but in general, people kind of gradually, and the representatives are aware of this too. We want to see the people do better, so we kind of help them along as well. So what we put together here for you under what we call the plan activity, just kind of give you an idea of what exactly is going on with your participants. As far as the assets are concerned, simply, just as Freddie said, just about $45.5 million. Now that includes the 457 and the 401. On the next page shows you the asset growth, again, over the last 3 years. We continue to do very well. Contributions, one of the things that we are graded on, or one of the things, I shouldn't say graded on, one of the things that we look at, how are people taking advantage of the programs? So you can see the different sources. You have, contributions, people rolling money in, people taking loans and so forth. Out of the 498 people that are participating currently or have made a contribution, the average individual is doing about $6,400 or just over $6,400 annually in contributions. That's pretty good. I have to say, in general, about $5,000 to $5,500 tends to be, if you want my unscientific, I work with about 100 employers. That's about the number, 5,000 to 5,500. The fact that you have the average individual deferring over 6,400 is actually really good. So the good news there is that people that are in the plan realize the value of the program and are taking advantage of it. On the next page, on 54, this is just kind of another way, if you want to take a look at how are your people invested or how is the money allocated in your plan relative to ICMA-RC's $50 billion book of business in the 457 market. Your plan, now on the 457 side, is at 29%. As I pointed out, that was through December. It's a little bit less. They were at 34% at the end of 12, but obviously the market growth is going to help that as well, because as the stocks grow, the savings account portion is going to shrink too, because it's only making a few percent. But relative to the rest of our book of business, people in general are a little bit more aggressive here. They tend to not want to focus on savings. They want to focus on growth, and they want to focus on performance. You kind of look at all the numbers as you go down into different categories.
What do you explain, at least my limited knowledge of international global allocation, it's significantly less than what most investment advisors recommend? Any explanation for that, even in just the aggregate amount, the 5%?
Wow, that's a good question.
I mean, I've been told up to 30%, depending on the recipe you want to get, of your portfolio should be in international stock and or bond.
Sean, I don't want to speak for you, but I think that typically our group here, at least within the city, seems to be pretty conservative in terms of how they're investing.
Well, not only the city, but their whole portfolio.
Yeah, I understand, and they're dealing with just municipalities, and I believe that municipalities as a whole, the body of people, is pretty conservative what they're investing for whatever reason. Plus, the other thing is the average age here and in other municipalities as well is going up. So you want to get out of that international at times. That's my 2 cents on it.
It's a good. I mean, it's a great point. It's a very good point. International had a pretty decent run last year, if I remember correctly. But international's also been lagging. And you turn on the news every night, people still tell you the United States is still the best game in town relative to the global markets. Germany's having a heck of a time. Europe continues to have problems. Now you got the Russians in Crimea, whatever. It's playing havoc with the global markets. So you are getting a lot of money into the United States market, which will also help that. How about we go to the next page? Let's take a look. And this is
Can I go back to?
Sure.
I'm curious about something. We have 498 participants.
yes, correct.
Relative to our size of pool, is that small or?
So that's just who's invested with us.
We have 3 plans.
Yeah, you still got people with the other providers. So we have, a little bit under half of the people here that are actively contributing. Now, those are the people that have contributed all throughout the year too. So,
Excuse me, those are active, not total participants that
That's
may
just
be
actives.
terminated.
that's
retired.
right. Those are just the people that are making contributions on an ongoing basis. If you go to the next page, when we talk about, one of the things we talked about, Dan and Freddie, we're talking about is we put education together. This is really, at the end of the day, this is really where the rubber hits the road. Because this shows you the breakdown of how our people invested in their age group for the different time frames. If you take a look, down at the left-hand side, that under 35 group, you bring up a great point about all the investments and so forth, and that's one of the reasons other two providers about target date funds. The green is target date. So even though you might have 50 funds or 102 funds, whatever, you're finding more and more, especially in the under 35 group and even in the 45 and under, they're going to the target date funds. Simply because a lot of people just don't want to be bothered. They don't understand it, quite candidly. But I understand that I'm retiring in 2035. I'm going to invest in the 2035 fund because that's my target date. I want to invest with that date in mind. I have one of the reps that I work with. I really like how he puts it. It's like you set it and forget it. I'm 45. I'm retired in 20 years. When I'm 65, bang, 2035 fund. I'm done. Just keep putting in my money, meet with my rep every once in a while, kick up my contributions here and there. But that's where the vast majority of assets are going. Also, what we're very proud of, and this plays out time and time again because it's just the nature of who we are and the way we work. You'll notice that the blue portion, again, is a savings account. We call it stable value. It's non-existent or very small for the under 35 group. If you're under 35, you need to be investing for the next 20 years. You don't need to have your money in savings. That's why the Department of Labor wants target date funds to be your default investment alternatives because general account, stable value, whatever, they're not appropriate for most employees. But what is appropriate, as they age, more and more, a greater portion goes into savings, but that's what you want because as you get older, you're going to have that flight to quality. So I would say, and I would just ask you, we'll keep an eye on this because we'll bring this back to every quarter, keep an eye on it because this is an appropriate allocation for your different age groups here at the city. And then also as we talk about who we're going to reach out to, well, you got 200 people roughly between 46 to 55 that are actively contributing to our plans and getting close to the pre-retirement years of the 56 to 65. We have the people like at or very near retirement. And you can kind of gauge and get an idea how many people we're looking to reach out to, focus on them, and say, you know what, maybe 46 to 55, and I'm just throwing this out there, 46 to 55, they're invested appropriately, I would say. So maybe we don't need to necessarily talk to them about investments. We should talk to them more about how do we plan, how do we tie in our Nevada PERS with our deferred comp, or if they're in the 401, et cetera. And it gives you a good idea of maybe how you can direct your educational platform. Any questions on that? Okay. Participation trends, again, 498 people contribute. There's 182 inactive. Some of those are not necessarily, Freddie had a good question, they're not necessarily all retirees. Some people do stop contributions because life gets in the way. They need to stop, whatever the case might be. We're very proud of our website. If you're not invested with us, check our website out. It's a great tool. But I've watched this now for years. I'm in my 18th year, just had my 18th unofficial anniversary with the company. It's amazing because I was here at the infancy of the internet. And everybody's going to the internet nowadays. People are taking it, and people are taking full advantage of it. The days of calling up and getting people on the phones, they tend to seem more and more in the past. And then finally, if you're kind of curious what's going on with the loans, in the last 12 months we issued 50 loans. So that means you have 134 individuals with an outstanding loan at the end of December. Only 7 have defaulted, and about 1.3 million is the aggregated balance of the group. The withdrawal trends kind of shows you, how much people rolled out, not rolled out. Most of these tend to be lump sums when people retire. And then a little bit, Julie, you were asking how many people are affected, kind of, if we get rid of a fund. Well, one of the things that we do is we can tell you, for example, I'm going to pick on a fund you just put on the watch list. So third one up from the bottom, the PIMCO high yield. Huh? Oh, I'm on 60, thank you, I'm sorry, thank you. No, 60.
60.
So if you look from the third, if you look for the bottom, third one up, it looks like this.
Page 60.
That might be my fault.
We go from 59 to 63.
59 to 63.
Uh-oh.
Go to 70 and
Do you have that where I can make a copy right?
I'll give it to, I'll give you my copy, you can make copies, my whole point is, real quick, I mean, you know, you need to say it. So you have the PIMCO high yield bond fund. You go all the way over here, you want to know how many people you would affect if you were to get rid of it? At the end of the quarter, there were 29 people that had a balance in. So those are 29 people that we would specifically have to reach out to.
so like on page 71, there's literally one person participating in the Oppenheimer Main Street Fund.
Another reason to phase it out.
Yeah.
Phase it out.
You only get one phone call, Drew.
I mean, there's like 2 funds with one person.
You don't understand. You do not understand, Ed.
I'm joking.
You know, there's...
I would love for anybody to come and sit at my office and take my phone calls for a day.
Yes, you're exactly right. In fact, you have, you have 0 because we eliminated those funds. But yeah, they could be 1. You'll have funds that are active that have 0 in it. Sure. People tend to self-select. If the fund's a dog, people know it, and they get their quarterly statements. They talk with the reps. I mean, we want to see people do well. I mean, it's not our job to sit there and watch them do poorly. Here you go. I'm sorry, I don't know your name. There you go. Take mine. We'll bring that to you on a quarterly basis, give you an idea how the people are actually investing, what your people are doing, kind of put some faces, so to speak, to the numbers that Freddie is referring to. Also, and Freddie, if you want, I can get you this information too. You know, again, as we get closer, as you start looking at and maybe consider eliminating, consolidating, we can get you the names of the people. I can actually get you the actual names of the people that might be invested in the PIMCO Total Return Fund.
Yeah, if we were
And all that is readily available to you.
If we were going to make any fund changes, I think one of the things we would do is do a mailer and explain in that mailer specifically why, and put it in black and white. It's almost to the point we could almost put it in black and white for the individual to show them what this change means to them.
Right. No,
I know.
There's a lot of things that you can do. Yeah, I wanted to give you this.
Oh, the number, if, there wasn't on there. So as a whole, the entire plan last year
Yeah, that'd be great.
Okay.
I'll do that.
returned 15.2%. That's pretty good. So again, remember, the market might have done 30, but not everybody's in the market. So you take that, you factor in the 3% on the stable, fixed, whatever, and you're 52, 15.2.
Yeah, no, I like-
That's pretty good.
I like this sheet that tells me how many people, because then I know.
Sure.
We have people that will call and complain just because they'll call and complain.
Julie, do you have a sense of, within your union, how many people are invested in ICMA versus NAS, or?
You know what? I'm going to say it's probably 50-50.
Yeah,
Without looking at numbers,
I can look at
that's
it.
a good guess. I would say 50-50. If I had to guess today. But hey, you got to understand. I got married in February. My name changed, and I had buku phone calls telling me that I didn't know what my last name was. So this is the folks that I deal with every day. So when you go to tell them that you're going to take something away that they want to be invested in, if you don't do the proper education, they're going to have a problem.
Understood.
Yeah.
So,
And Julie, I would say if you do get a lot of calls, or anybody else, just give me a call. Ornella's here all the time. We have this information literally available to us at our fingertips.
you know, I just gave her my card because I do want to sit down and meet with her, and
Good.
maybe we can come up with some different things. Along with Dan on that, I want to meet with her because I have money invested with you guys. I don't need Dan to meet with me on that one, but you know what I mean, just different things to be able to educate them with regards to why we may or may not make some of the decisions that we do. So.
Thank you. I mean, I don't have anything else. I want to say thank you.
Thank you, thank you.
2 more to go. Good luck.
Bring it back to me.
Hey, Ronella, can you wait 1 minute? Come on up.
Oh, yeah, sure.
Want to break for a sec? No.
You sure can.
We'll adjourn for 5
and-
minutes.
all the other people were split up in different apartment buildings in different places.
Cool.
But it was pretty cool. You know, Tom was talking about index funds and I think we have a large amount of our funds with PERS invested in index, and it's fixing to be a whole lot more. The active management is, the rates of return are basically the same, or better, with index and now with active management, so we're just looking at, and fees are cheaper.
Always cheaper.
Always. So we're looking at having a lot more index funds with PERS, a lot of stuff out of active management and index.
Yeah, I mean, you can make a lot of compelling case for index funds. You know, I'm objective, open to it. You know, it's a good argument. It's a good debate, both sides. You know, I can share my 2 cents at some point, but asset allocation rules the day. Index versus passive is important, but you know, at the end of the day, not as important as asset allocation. Are we ready to begin? Okay. Well, this is the Mass Mutual Review. Does everybody know Robert Ternary and Janet Corral?
I think I met we just sent cordials and stuff, so I think we're good.
Okay, good. Well, so what we're going to do is we're going to have a fund review, and we're going to ask for an update from Mass Mutual, and then we're going to have a target date presentation that we prepared, because remember last quarter we identified that the State Street Global target date funds as badly underperforming because they're very conservative, and so we have some presentation for some possible replacements. So we'll get started with page 8 is our executive summary, and this is a list of the 6 funds, 1, 2, 3, 4, 5, 6 funds that were placed on the watch list from last quarter. And the reason, because of course our investment policy guidelines annualized performance. Page 8 is the 30,000-foot view, and there's 32 funds with Mass Mutual. I beg your pardon, page 10. And maybe some consolidation opportunities. Page 11 is the performance summary. So out of the 32 funds for the fourth quarter, 9 funds ranked in the top quartile, 2 funds in the top third, 4 funds in the top half, so that's the good part, 7 funds in the lower half, and 3 funds in the bottom quarter. So more good than bad. 14 of the funds beat their market indice benchmarks. 2 funds were about equal, and 9 funds fell below their benchmark. Invesco American Franchise A was the top performer, up 13.25%, ranked in the top third percentile. Fantastic. Skyline Special Equities up 12.57% in the top 2 percentile. Hartford Healthcare returned 12.09% in the top 10th percentile in this morning category. So those are the fund highlights. And then on page 13, this is the plan composition.
Freddie, just real quick,
Yes, sir.
maybe I might know the answer to this already, but when you said they have 32 funds,
Yes.
and in the overall performance, 9, 2, 4, 7, and 3 don't add up to 32. Is that because some of these funds are tied together into one, like the last one where they had 3 funds that were kind of under the same?
In the fund highlights, you're saying...
in the overall performance.
Okay.
So you have 9 in the highest quartile,
9 and
2 in the top
11.
third, 4 in the top half, and then you have 7 in the bottom half, 3 in the bottom quartile. That only adds up to what, 23, I don't know, 10, 6,
9,
25 funds. So
25
where's the other 7?
funds.
Are those the,
So I'm wondering if the
Well,
target
one would,
target date?
target dates that it is one fund, but they're target dates or something, I don't know.
you know, that's a good question. That could be the answer, because there is 1, 2, 3, 4, 5 target dates. So that would be the difference plus the stable value.
And then we have the S&P 500, the State Street S&P 500 might not be.
Well, no,
Probably.
that is a benchmark itself.
Yeah,
Yeah,
it is.
so that's probably a fair answer, but I can verify that. I'll look into that.
Just curious.
Okay. All right, so the plan composition starts on page 13 and ends on page 16, and there's $131,713,618.
And this is for both the 457 and the 401A,
That is correct, yes,
Okay.
yes. Yeah, and, I talked about, replacing or looking to possibly replace the target date funds. You see on page 15, not a huge aggregate amount. There's $545,000 in there. And then on page 16, still, somewhat of a concern is that, but we'll talk about it through our educational initiatives. There's $63 million, which is 48% in the general account. Pretty, weighty position for a fixed account. And on page 17, there's a picture of the plan asset allocation. Page 19, investment criteria, top 50 percentile, 3 and 5 years. And then on page 20 is our scorecard detail. And, starting with the MFS government securities bond fund. That fund was not on watch before, but should be placed on watch, or at least we'll see if there's a motion to do that. The funds on watch, going down American Century Equity Income, 94th and 98th percentile, respectively. It's actually gotten worse. Last quarter, it was 91 and 63. So, clearly that would remain on watch. And then on page 21, you've got the Janus 20 that has been on watch. Has improved a little bit. Last quarter, it was in the 78th percentile and 63rd, and it did improve to the 60th and 62nd, but that would certainly, remain on watch. And then the Goldman Sachs mid-cap value is on watch, I should say. Last quarter, it was in the 56th and 51st, so that's gotten worse. And then the Victory Special A for the mid-cap blend category, 95 and 92. Stayed about the same. Last quarter it was in the 95th percentile over a 3-year period and 94th percentile over a 5-year period, so that should clearly stay on watch. And then on page 22, the Janus Overseas is on watch, and last quarter it was 99th and 100, and on the 3-year it stayed at the 99th, and on the 5-year it got a whole lot better at the 49th, but that would presumably stay on watch. Yep. And then the American Funds Capital World Growth and Income, that fund was on watch. Last quarter was in the 62nd percentile over 3 and 5 year, and got a lot better on the 3 year, up to 42. And on a 5 year, it went from 60 to 65, dropped off a little bit. So those are the 6 funds that were on watch. And with consistency from ICMA's review, how does the committee feel about keeping them on watch for another quarter? There is some, improvement on a couple of funds on one of those measures.
Motion to continue these 6 funds on watch, as we did with the other funds.
Is there a second?
I second.
All those in favor?
Aye.
Aye. Any opposed? Hearing none.
Okay, so we will keep those 6 funds on watch.
I make a motion that we add the funds that are below 50% for the 3 and 5 years. They're also added to the watch list.
Okay, and let's identify those, please. On page 21, the Invesco American Franchise A.
Including the first one, on page 20, the NFS government securities.
Yes, that's the first one.
Okay.
On page 21, the Invesco American Franchise. And the Invesco Real Estate Fund on page 22.
Freddie,
Yes.
do you have any more of those books? One of those members doesn't have one.
Oh, sorry about that. Thank you.
Do you have one?
Yes, ICMA, he's.
That's right. I was looking at yours.
Thank you.
Yeah,
Boy,
it's
I
very
have a hard
different.
time following. All right. In the wrong start of the copy.
Uh-huh.
He said about the 7.
Mhm.
And that,
And then on page 22, the Invesco Real Estate A. So is there a motion on the floor to put those 3 funds on watch? Add those 3 funds to the watch list?
So moved.
All those in favor, say aye.
Aye.
Opposed? Motion passed.
Okay. Dan, should we talk about the Mass Mutual update? Should we get into, and again, just like ICMA, of the 32, 6 funds are on watch. We added 3 more. So that leaves, what, 26, 25? We can review each one, fund by fund, if you'd like.
I was just going to say, Dan found your 7 funds that you were missing on your total thing. Those are all the target funds. Because they're not rated by morning, they're not screened by
There's a
Morningstar.
blue
Oh.
icon
Okay,
next to the funds that weren't rated.
thank you.
They're your other 7.
Okay, thank you. So I'll cross it off. Appreciate it. Thanks, Dan.
There's 5, and there's 2 other ones, the 6 and 7 are on page 21.
Oh, okay, thanks. I wasn't counting that.
Is there an interest to look at the other funds' performance? If not, we'll go to a Mass Mutual update. Anybody have an interest on, and again, I want to make it clear that, starting on page 28, I've gone line by line, and each fund is compared to a fund category and an underlying benchmark for the quarter, year to date, 1, 3, 5, and 10 year, and it has a category rankings. And the funds that would be of a concern have been placed on the watch list with 3 added, so. If no questions, then Mass Mutual update.
Okay. Thanks an awful lot. Quickly on Mass Mutual, we're in our 15-month since they purchased the Hartford retirement business, and things are going along very well. We are actually adding personnel to the retirement side. It's been going along very good. And Mass Mutual had another great record year from a standpoint of their insurance business along with their retirement business, and so the company's done very well. On the retirement side here, back on February 11th, Caitlin Weisgerber, our communications specialist, and Janet and myself met with Freddie, and we met with Dan, and to discuss communications and education. We talked about the target date funds, talked a little bit about the Roth, and where we're headed, what the plan may want to do with the Roth. We are ready to implement that at any time that the plan wants to go ahead and move forward with that. Target date funds, I provided Freddie with the information. We're going to talk about that in regards to the target date funds, the SSGA funds that you currently have, and the choices that you may have. I would tell you that a lot of our plans are looking at the SSGA funds because of the 5-year underperformance. Would like to point out to the committee that I think Freddie did point this out to you, that those funds are to retirement, not through retirement. Because of that, they are a more conservative-based target date fund, and they are acting in the way that they should. Because of that, they're more conservative in nature, more bonds, and because of that, bonds have been underperforming. The ones that we've provided information are going to have, they're through retirement, so they're going to be a little bit more aggressive. They're going to have better returns. I just want you to be aware that in an up market, they're going to look better. Those through retirement, the down market, maybe not as good, whereas what you have right now in a down market, they'll look a little bit better. But just keep that in mind as a plan. So we're ready to make those moves depending on what the plan wants to do. Activity-wise, Janet and Anthony have been very busy at the City of Las Vegas, and I know we do continue to have a large amount of money that sits in the general account. We talked about a mailing campaign to those individuals that have 2 or fewer funds in regards to asset allocation, and I know Dan and Freddie, I think, are going to try to get together and decide what we want to do on that. And then some of the other things we talked about, like a investment palooza. They had basically it's an investment seminars that would be through the city. I know they did one here for the health fair. Now they're thinking about doing one maybe for investment. So that's kind of an overview of what's going on with us. I'm not sure if there's any questions from the committee that you have for us. Dan, Freddie, if you have anything for us at all.
No, and Dan's going to, drill down and give some more.
We'll give you more detail on some of the campaigns we'd like to implement, and then the finance blues.
Yeah, I think I made her first this morning.
As it relates to the target date funds, in the review book, let's just kind of do this fundamentally from the ground up. If you look at the scorecard detail, page 22, thank you. And you see the target date funds, and you see the rankings that are very, very low. And that's because, as Robert said, they're very equity light. They were put in the plan a long time ago, and there weren't a whole lot of choices, and they may have been a very viable choice at that time. I put this piece in your folder, and I don't expect you to read it, but I'll go ahead and read you some highlighted excerpts I've prepared. And this is a bulletin, interpretive bulletin from the Department of Labor, Target Date Retirement Funds, Tips for ERISA Plan Fiduciaries. Target date retirement funds have become increasingly popular in defined contribution plans. The U.S. Department of Labor has prepared general guidelines to assist plan fiduciaries, that's us, in selecting and monitoring target date funds and other investment options. The target date refers to a target retirement date and often is part of the name of the fund. Target date 2030 or 2020 are designed for individuals who intend to retire near or during that year. Because of these features, many plan sponsors decide to use target date funds as their qualified plan default alternatives. We've implemented our investment policy statement that target date funds are the QDIA investment vehicles. The shift in the asset allocation over time is called the target date fund's glide path. It's important to know whether a target date fund's glide path uses a to-retirement or through-retirement approach. A to-retirement approach reduces the fund's equity exposure over time to its most conservative point at the target date. A through approach reduces equity exposure through the target date so that it does not reach its most conservative point until years later. There are considerable differences among target date funds offered by different providers, even among target dates funds with the same target date. It is important that fiduciaries understand these differences when selecting target date funds as investment options in their plan. Things to remember: establish a process for comparing and selecting target date funds. Plan fiduciaries should engage in an objective process to obtain information that will enable them to evaluate the prudence of any fund to or through retirement. And we're going to show you something that is an objective process. And then another highlight: document the process. And this is something that, we've emphasized from the beginning of this committee, is that every decision the committee makes, it's a documented process to substantiate the decisions made. So that's the background. And so what Dan and I worked on together is, this is an analysis, okay? And this is a report that was done. And the background is that, starting in about 2006, when target date funds became kind of in vogue, there was only about 6 to choose from. And now fast forward, 2014, there's more than 30 to choose from, and the world has realized that, all target date funds aren't created the same. And you should have an objective process to establish whether your plan should have a to versus through. And so what this tool does is that there was this questionnaire that Dan and I went over and, basically answered as a proxy for the committee. And I would say, who better than Dan with his pulse on, the 3 different providers to answer these. And the answer is, it's A or B, and then the software, engages an algorithm to have this output. And the responses yield an overwhelmingly indication that the city should have through retirement funds, funds that are more equity heavy. Does everybody kind of understand that. And, some of the reasons were, number one, average account balance is, 90 some odd thousand. That's a lot of money. You have the PERS, which is another, retirement leg to fall on. Conversely, more in the casino, segment of the retirement plan market, where average account balances tend to be a lot less, and people at retirement, liquidate their funds, whereas here, there's many retirees who keep their money in the plan. It, yielded an overwhelmingly indication for a through retirement. So, the three funds that we've compared are MassMutual, Retire Smart, T. Rowe Price Retirement, and Vanguard Retirement. And you look, and unfortunately these pages aren't numbered, and I apologize for that, but we're looking at the graph here, the blue and the green. So the blue is the overwhelming score that indicates through retirement. And then on the next page, getting down to this competitive analysis, here's the average expense ratios. Now, one thing I want to keep in mind is, as we get through this report, this is a series of target date funds. It may start on 2015, they go to 20, and then 2030, 40, 50. So this is an average expense ratio of the whole series. And you see here the glide path. You see that these all have significant equity exposure at retirement, 47, 49, 41. And Vanguard takes a more conservative approach, meaning that their glide path ends at age 70, where T. Rowe Price 95 and MassMutual 80. And then it shows how diversified the funds are in terms of asset classes and them being fund of funds. And I'm going to go to the next page, and here's a graph that shows, again, the glide path at retirement and the equity exposure. So you see that T. Rowe Price has the most of the three. And then on the next page, here's a graph that shows it shows the equity exposure and standard deviation. And then on the next page, this shows the number of asset classes that are represented in the portfolios. And then the next bar chart, just about the tips and hedging in terms of some defensive strategies. And then the gold bar charts, just a number of management firms. These are basically fund of funds that are all made up of the same fund family, but different funds exposing different market.
Generally, these funds just invest in a palette of funds that the fund family would otherwise offer. They just come up with an allocation of the funds that they have in the fund family, and they pull it into a retirement.
That's correct. Yeah, that is correct. Yeah.
They wouldn't, like MassMutual wouldn't invest in a T. Rowe Price fund. They would stick all the money into various MassMutual funds. T. Rowe Price would stick with all various T. Rowe Price.
That's right. Yeah. Now here's an interesting slide, and again, it's inefficient that these pages are not numbered, but on this page, John, you have it, Edward? Yeah. So this shows you, and for continuity, let's just use the 2020 fund for the comparative analysis. So you see the up capture for MassMutual's up 79 when the index is up. They capture about 80% of it, capture 74% of the downside, where Vanguard captures 66 of the upside, 61 of the downside. So that's more of a muted, steady as she goes kind of approach. T. Rowe Price, a little more aggressive, capturing 78.5% on the upside, about 71% on the downside.
Fred, can I ask you a question?
Yes, Robert.
On the downside, if you're capturing less on the downside, will the number be lower? Is that right? So like this Vanguard has a 60.95. So in a down market, that means that you won't see it go down as much as you would the Mass Mutual and the T Row. Do I interpret that correct?
That's correct.
Okay.
Yeah,
Okay.
that's correct.
Thank you.
Yeah. And then on the next slide, this is just a visual of, on the up market, on the upside, you want, anything to be above the green line. And I would, if you really want to get down to the, the real, essence of this, if you go to this page, which is towards the end.
It says risk return?
No, standardized performance. Yeah.
It's the second to last page.
If you just, let's say, look at the 5-year number of the 2020 fund. T Row price is, probably the most compelling.
Now, if Mass Mutual is overweighted in stocks relative to T Row Price and Vanguard, wouldn't they have an expected greater return over the 5-year period when the market has done fairly well?
Well, you would think, but I have another. And by the way, just as a sidebar, Stage Casino is a client of mine, and we've had the T Row Price funds in there for a long, long time, and they're through retirement. And I've gotten Stage Casinos, coincidentally, to look at those as being not appropriate for them, and they're probably going to change them out. But the T Row Price funds over a 3 and 5 year period, the ranking is in the top 2.5% for 3-year and the top 1% for 5-year. So they're really the category king as far as the through retirement.
But that's because they're capturing more of the upside then?
Yes.
Yeah,
Yeah.
okay.
With less risk.
Mhm.
Yeah. Now,
Absolutely.
Now here's what, and so, there's a very compelling argument for T Row Price, but all of these funds, as Robert mentioned, because they're equity heavy, they're through retirement. So in up markets, they're going to rank very high. But if the market corrects, they're not going to rank high. Okay, but that's where the hedge in your investment policy states that there's no hard and fast rule for replacing a fund. And so I believe that you have to put a premium on having the right type of investment vehicle, knowing that you have to deal with how that fund is going to react in up markets and down markets. Any questions, comments? The other thing that I will mention is that currently the State Street Global Advisor Index Funds expense ratio is 80 basis points.
85? Or is it 80?
I think it's 80, is it? Where revenue sharing is 50.
No, the revenue sharing is 50.
Yeah.
Right.
Yeah. And the T Row Price funds are 69. So on about 545,000 or so that's in these target 8 funds, you are going to get a cost reduction on that.
And the revenue share that comes back to Mass Mutual is like 15 basis points, I think, on that, instead of 50. So it's a lot less.
Yeah. So, while the committee has taken a very, deliberate approach to putting on funds on watch, because of annualized performance, you know, it's agreeable that, you know, you want to keep them on watch another quarter. But as it relates to target date funds, you know, I would like to suggest to the committee to consider that, you know, if you want to start actually getting some things done, you know, we've identified a block of investments that is about 545 some odd thousand, that the rankings are number one, so poor, and number two, we've identified that they're the wrong type of investments because they're to retirement, where you should have through retirement. I believe here's an item that you can actually take, take action on and make a motion to replace the existing target date funds with the T low price funds.
This survey that you had the graph, that was actual city employees that were surveyed? This graph, who filled out this survey, or how many?
Well,
48
Dan,
people?
yeah, no.
No, that's a
Yeah.
scorecard.
That's a
Oh,
scorecard
okay.
that is a result of this questionnaire.
That was filled out by
Yeah.
city employees?
No. This is
Well,
a
just
committee.
by
This
Dan?
is a committee.
Oh, I'm sorry.
Yeah.
Okay.
And so,
Do we know, just out of curiosity,
Yeah.
do we know how many members have, make up that 500 and?
I was just trying to find that, and I can't find it.
So in other words, how many calls is Julie going to get if you change these funds out?
who's got your back, Julie?
Thank you.
We're all concerned about you, Julie.
Hey, it might be one person
I
there.
know.
Well,
It's a
Performance of the
small
fund
number.
up? I doubt it.
yeah.
Yeah.
Julia calls and say, why didn't you do it
And-
last quarter?
And, you know, let me just, you know, when it comes down to this questionnaire, you know, the reality is, you know, the committee meets, you know, once a quarter, but intra-quarter, I'm having countless calls with Dan, meetings, doing so many things, you know, behind the curtain to get ready for this and, you know, try to move the ball down the field. You know, the thought was, who better than Dan as a proxy for the committee that, you know, has his pulse on the deferred comp plans. You know, we considered, okay, should we, you know, pass this around, but then it's going to take up time. And I would submit to you that even if one of the committee members had a different opinion as to what a couple of the answers would be, it would not have made a material difference in the outcome of the score. So try to make it, you know, something you can execute on. And,
He's looking at me. Julie, you know, I just think that, no disrespect, Dan is not a member of this committee. He is here as a representative for all of the thing and for HR. The committee is set up to do those types of things, so I think in the future, I'm not going to say anything negative with how you chose to do it this time, but we all have email. You know, on certain things that we're going to do, those kind of things, I think that maybe the committee should have a vote, or we should all, the whole entire committee, voting committee should do those. Maybe I'm the only one that feels that way, but
no, you know, that's a valid point. It
I
is.
mean, because, you know, basically, I think that, you know, that's the reason we have the committee. So that's.
Yeah. Well, then, if you want to make a motion to suspend taking action pending a committee's, you know, answering this, we can certainly, you know, defer another quarter. You know, it's whatever your preference is. But please know the intention was to try to facilitate, not to, you know.
No, I understand, but for some of us, we've got to go back and explain to our members how things came about. And if we weren't a participant in how we came to this derivative, that's not going to look well for some of us.
Okay.
Other folks, it might look perfectly fine, but for some of us, it won't look very good. So I just want to make that point.
Fair.
Dan, did you find that number?
No, I didn't find it in here.
Number of participants in the target fund.
I don't think it's in this particular report. I can tell you though from the amount of assets that sit in there that it's a small number. We can, you know what, if you can give us a couple minutes, we can probably
Pull it up.
pull it up on our computer and give you those
I think
numbers.
that you're gonna find that the most participation is gonna be in that 4% return fund.
Oh, well, yeah.
Oh, yeah,
absolutely.
yeah.
No,
That's-
that's
No, we just
Yeah,
want to
that's
know
pretty
the
good.
target that you're going
So-
to set.
Yeah.
But I bet you the largest fund doesn't have 20 participants. I don't know off the top of my head.
And
Jan,
that, the
whatever.
question was asked, and I'm curious too.
Yeah.
So that's,
Yeah.
It's a good
Sure.
question.
No, it's a,
And I guess the other question that popped into my mind, Robert, that if when you got these three funds here that they evaluated, the Mass Mutual, the T. Rowe Price, and the Vanguard,
right.
implementation, how easy is that for you guys? Do you guys go out and work the deal? Do you guys go out and cut the deal with T. Rowe Price to?
Oh, no, that's
bring that
already
into the
done.
fund, or-
I've done all that already.
Yeah, these
So
are
you've already done
Freddie
all
and I have been
preliminary
working
stuff
together,
with them
Yeah.
to try and
Right.
make that so that it's a smooth transition.
Oh, it's a
for
very
in the
smooth
event,
transition. I mean, I
The
was,
termination of State Street and the movement into some other fund.
Yeah, before these funds were selected as a competitive analysis, we've already screened that, is T. Rowe Price approved on Mass Mutual's trading platform? Yes. What's the cheapest expense ratio we can offer? And still, yes. And so, yeah, that's all trimmed.
and then there'll be a communication that goes out to all participants that have a balance with us, whether they have $1, they're going to get a communication. We'll let them know that the date that the fund is going to be added, and then we will let them know the date that if they don't do anything, that the money will be mapped into the corresponding fund. So that and it's just communication. I would say from if you vote today, then I would say I'm guessing 60 days we could do it. So here it is, the middle of March, something like the middle of May is probably around when we would.
Which is about typical.
Yeah. Or you could do it at a calendar quarter or at a month,
It's clean up.
first
Probably
of the
it'd be
month.
better to do it at a non-calendar quarter.
A non-calendar?
Yeah, I think it would be, Freddie, but we could still do it, so.
Okay. But whatever the committee's preference is, regardless of how many people are in it, if you want to defer for another quarter, pending on, pending the committee's input on this,
No, I have it on, we can get it on here, it's just,
Because it's
the
so I run
Wi-Fi
my
is horrible
version,
here,
right?
yeah.
yeah.
The
5:45.
Wi-Fi doesn't work, right? You don't get a lot of great.
Your phone doesn't like a lot.
No, even though I'm close to the windows.
We're talking about picking one of the three.
100.
Mass Mutual.
Well, no, but I'm sorry,
what are we referring to other than changing from a 2 to a 3?
or two,
And also,
what fund now? Yeah, T. Rowe, Vanguard, or Mass Mutual.
Does Vanguard offer such a lower, what do you call it?
Expense ratio?
Expense ratio just because they're
That was my
investing mostly
question.
index
Well,
funds?
all Vanguard is index funds, so they're always.
Well, I
gonna
mean, they
be
have a
cheaper.
lot of active managed funds.
But their shtick is, index funds, so they're always going to be cheaper.
That was one of the questions I had. Based on the cost ratio, the expense ratio that you see here, this is an example, looking at the 2020 expense ratio, you got 53 basis points difference. Certainly the rate of return on the T. Rowe Price exceeds that of the Vanguard pretty much across the board, it looks like. But if your rate of return costs you 53 basis points more to get, how much do you save? What's the better option? If you're spending 53 basis points to get a better rate of return,
Yeah.
are you exceeding? Is the rate of return exceeding the cost that you're spending to get
Justifying
it?
the cost?
Justifying the cost to get it. That's the
Yeah,
question.
well, I would,
Right now.
in my mind, is that return is return. If you can get it, it's not a matter of
Return
cost.
return on a hedge fund too. If you happen to hit it at the right time, but you're going to pay 2 and 20, is it worth it?
2 and 20, I start the hedge fund,
Well, if you look at all of the numbers here that Freddie's provided, it looks like they're almost 300 basis points higher. So even though it's costing you 53 basis points, you're getting 300 basis points, so it seems like the extra expense warrants the return.
Yeah, you're getting 3% return, so.
Oh,
Pretty consistently, you're getting about a 3% difference rate of return, so. So you still have a 2.5 net, if you will, roughly. That makes sense.
Yeah. And if you look
What
at
is
the
going on, when you have risk return statistics, you have a return percentage of 14.32 for 2015, but then you go to the next page and it's standardized performance. Oh, I'm sorry, it is the same, okay.
You return 15.6 as opposed to 12.7.
Okay. Yeah. Okay, there it is.
Yeah.
Here's a question for you, Bob. Your company is carrying the fund. How do you feel?
It's a committee decision.
I certainly understand that, but I mean, but
Are you asking me for my personal opinion, or?
I mean, if you guys are putting the fund in your packet that you're going to be offering to the members, I mean, do you feel comfortable? You good there? I mean, certainly, if you're representing Mass Mutual, I understand Mass Mutual's looking at the expense ratio is higher. So, yeah, I mean, from a Mass Mutual standpoint, why not take the higher expense cost? I mean, expense ratio.
No, Rusty, the expense ratio that the participant is paying doesn't necessarily equate to the revenue to Mass Mutual. There's a revenue sharing of that goes to Mass Mutual. Now, currently, under State Street, Mass Mutual is getting 50 basis point reimbursement. That's very rich.
Mm-hmm.
We're going to something that has a low expense ratio, the participant, but even less revenue sharing to Mass.
Considerably less revenue.
Yeah, that's just because Mass on the whole 140 whatever
Right,
million, they
right.
have so much revenue in aggregate, they can give up a little bit on that piece.
That's right.
But you know, any of these funds that are offered on the Mass Mutual platform, they're all, you know, quality investment vehicles. It's just a matter of what comes down to the preference of a committee, you know, based on cost, return.
So the bottom line is this, and no offense, please
Yeah.
don't take it wrong,
No.
but the bottom line is this. You have an affiliate association of some sort with T. Rowe Price.
I don't have any.
You said you already used T. Rowe Price with several of the other clients.
Oh, no,
And so if you're recommending T. Rowe Price to Bob and Bob goes, yeah, I think that's good, I'm okay with that as long as Bob feels that he's offering that and he's offering good quality something to our members, as opposed to you picking, you don't have skin in this game, but he does, and so do our members. So I want to know, what do you think, because you have skin in this game as our members do.
Well, I think the T Row is probably the most popular selection that is out there right now in the market. Okay, that's what, when we meet with our plans and they're evaluating it, it seems like T Row is rising to the top with most of them.
Certainly the 3 and 5 year rate of return.
Well, and that's what they're looking at.
And the interesting thing is we have 50% of the participants in the Mass Mutual plan in cash. Yet
Right.
we're looking at going to a target retirement fund that is the most aggressive. There seems to be an inconsistency.
Well, no, it's the most aggressive. That's why it's performing so, because it is equity.
But
And-
50% of the people in the plan are in cash, yet we're evaluating a target retirement fund
And it's
that has the largest stock allocation of any of the three.
My computer's locked.
But the-
I'm just making an
I can only
observation.
get a breakdown of the cash.
Right, and to T-bone off of that, Julie hit all, I agree, because the people that are in that fixed account, the largest number of the people that's with them, they're not gonna change. It doesn't make any difference how you do a different vehicle for them to retire. They're not leaving that account that they're in currently. And I think for me, Bob, my question would be, if you was to recommend a different one, which one would it be that you would recommend? Not what he's saying, but what would Mass Mutual recommend to this committee as an option to replace what is on
Boy,
there?
you're really putting me on the hot spot here.
What would that be?
I mean, I'm sorry. I mean, do you want to answer? Get back to us next
No,
quarter and answer that
no.
question?
We are not a fiduciary here. I mean, we are not a financial advisor. I mean, for me to do that, I would be out of compliance. I really and truly am not allowed to do that. I personally would look at the numbers, I would look at the expenses, and it all depends, again, I'm giving you my opinion on what it comes down to. The T row, these are all through retirement. What you have right now is not through retirement. It's to retirement, okay? It's almost an apple and orange issue, because if the market, and Freddie mentioned this, if the market turns, you could see where your SSGA funds do a little better, okay, than what these might. But in the same respect, you have SSGA funds that have an expense ratio of 85 basis points or 80 basis points, and we're receiving 50 bips of revenue, 50 basis points of revenue. You look at these funds, the T row, we receive 15 basis points of revenue. We, Mass Mutual, that's what we're getting out of that, okay? The Vanguard, we receive nothing. But we will add those on to your platform. So it really is you as the committee that has to make that decision. I'm sorry to be evasive, but we as a record keeper provider here, if you want to put the T row, the Vanguard, leave it as you have, that's fine. I guess if I was going to, that's really and truly my answer to you. They're all good choices. You're not going to make a bad choice. They're good investments.
And I think my observation about the majority of the people have the money in cash may incline me to say, okay, well, maybe they should have a more aggressive target date fund then. Because if they're going to stay in the cash anyway, they're probably not going to move it. So the people who want some equity options may have a preference for a more aggressive equity target retirement fund. Otherwise, they're just going to put their money in the cash and be happy with their 4%.
You know, it's. I would add that it's nice to talk about the general account and money, and that's part of it. But this particular discussion should be central. Isolated to those target date funds. That's what we're talking about here. What I'm trying to do as a consultant and try to make this committee good fiduciaries is I'm trying to build this discussion from the ground up. Okay, laying the foundation with the Department of Labor guidelines. Okay, that you should have an objective process, the questionnaire that yields a scoring system. There's two decisions. Should you have a to retirement or through retirement? Okay. Right now you have a to retirement. If based on how Dan answered the questionnaires with me, it's overwhelming that you should have a through retirement. So you should be changing the state street funds. Then the next decision is of these through retirement funds, which one you should have. And I want to make it clear. I don't care which one you pick. I'm not soliciting any particular fund. What I do know is I have a lot of experience in creating this report, which, by the way, does serve and comply with the Department of Labor guidelines as having a documented process. That's what this is, okay, so you can feel good about that. But I have no connection. Rusty, I don't have a connection to T-Row. I have a high degree of familiarity with T-Row, okay? So, again, I think you should, try to move forward, either, make a motion to pick one of these funds, or Julie, if you're concerned, which is valid, I've heard you, and that you didn't have a chance to answer this, then I think the motion should be to defer to another quarter. These funds have been in here forever. There's no reason they can't stay for one more quarter. And if this is important to you, I take it to heart. If the committee would like a crack at answering this to see if the outcome would be materially different, okay, from what this graph says, then that's a viable motion. And then we can start over and revisit this next quarter. But at least this with all the things we're doing, what I feel is at least the one carve out that is something we could actually take action on. and move the ball down the field in the football vernacular is on the target date fund. So,
Just so I'm clear, this was filled out by the committee last.
no, it was filled by Dan and I, because Dan is probably the most viable single individual that would have, can answer this with the most significance, I believe.
So do we need to have a motion to vote to accept Dan's filling out of the scorecard or something?
No,
I mean, just for the committee members, I'm asking
Yeah.
them, do they want to do that so that we can know whether to move forward or to wait till next quarter as we fill it out? So I don't know if we want to vote on that real quick or not.
I'll make a motion to hold off on this decision until the committee can fill out the questionnaire and turn it in and get a better accounting until next quarter. Just throwing it out there. No? Okay.
Yeah, I'll second it. I'll second it.
Can I have some discussion? Does the committee filling this out meet the intent of your analysis of whether we're meeting the Department of Labor requirements?
Absolutely.
Or is Dan filling it out?
Oh, yeah, yeah. The only thing that, I guess in practice, I think that, let's try to do something we can actually execute on. Let's suppose I'll email this to everybody. You can fill it out. Dan can collect them, okay? I'll meet with Dan, and my very strong hunch is that the answers, they might vary a little bit. They might deviate a little bit, and maybe we can run a sort of an aggregate of how the committee answered them, and we'll see what, basically the score is, and then we can just revisit this next quarter.
I appreciate that. I just more wanted to know if we want to vote on that because my feeling may not be the same as Rusty's feelings on whether they accept the scorecard or not. And Rusty's feelings may not be the same as Julie's feelings. So don't know. That's why I suggest we just do a quick vote, and then we can know whether we need to move on or not. So,
Looking at these questions, I think it's pretty obvious what the answers are going to be, honestly, if you look at them.
Well,
Other than question 6.
Yeah. And again, if everybody had, if there was half and half answers to 6, again, it would not materially affect the outcome of 2 versus 3.
But I'm willing to, if we can do it, get it back to you and have some email distribution of it, so at the next meeting we'd be prepared then to definitively take a vote rather than have a discussion on the survey.
That's, yeah.
Julie, I mean, for me, and I'll clear it up for everybody. My point when I started out to make my comment with regards to the fact that Dan did the card and he's not on this committee, I also said in that statement that we'll accept it this time, but going forward from today, we truly need to have the people that are on this committee making these kind of decisions because they are the committee and that's what we're here to do. So I have no problem with the fact that Dan did it. I was just making a point, and a valid point going forward, that the committee, the voting members of this committee needs to be doing these kind of surveys and things. And the last question that I have, and we'll move on because looking at it, I don't think the outcome is going to change either. But are those the only 3 available things that we're looking at? The ones that you proposed, are they the only 3? The T. Rowe Price, the Vanguard, and the Mass Mutual. Are those the only 3 available in the entire market? The best 3 performing out of everything.
There's probably, basically I have. It's a grid, okay, and it basically plots. Left of this line would be the to retirement, right of the line through retirement, okay, and then it has a line of diversification and the ones that are more diversified, the ones that are kind of like more readily used in the marketplace. We want to represent, give a representation of the mass, and then. I thought it would be, prudent to offer, to include a low-cost option such as the Vanguard Index, and then a fund that I'm very familiar with that, I talk about adding, highly ranked funds. Well, why not add the top-ranked fund if you could? So, that was my sort of my proxy of the marketplace. Is it perfect? Perfection doesn't exist. Is it good? Is it viable? Absolutely.
I think your selections are good. I personally have investments in both companies. I'd be comfortable with either option, and they're major companies that are not going to go belly up or Madoff something or other. And I think
No guarantee in
I
that,
think the
but you can say that
selections
today.
you made
Yeah.
were very good.
But Julie, consider this. We're going from, at least in this analysis, from the 100th percentile to the first. So if you're looking for a quote-unquote better fund, I don't, which one is it? Is it the 31st ranked? I mean, I'm trying to, at the end of the day, I'm trying to simplify it and do as much as I can, behind the curtain to bring something to the committee that they can actually take action on, and make some hay. Because when you really think about it, what there is to do is voluminous. There's so much, okay? And I'm trying to simplify it the best I can for the committee.
Another thing too, Julie, I'll just add on, is that our platform does not have every single target date investment. There were some parameters that we looked at through retirement and then top performers, and came back with these three that we would be able to support on
That's a
our
very good
platform.
point, Robert. And somebody said, you should really look at the American funds. And American funds, they have a lot of very good investment vehicles. So I asked Robert about the American funds. He said, unfortunately, that's one fund that's not available on our platform. Okay, so, all right, so we'll leave it off. Now, next meeting is with Nationwide, and American funds was available, so I included it in the next one. So,
I think there's 4 funds we looked at with the Nationwide.
right, yeah.
There's a motion on the floor. The motion was that we put it off for 1 quarter. There's a second. We're in discussion. Is there
And
a
fill
vote
out
on the
the
motion?
And fill out the questionnaire, correct? So do we have a second on the motion?
I'm second.
Hearing no
But
second.
I will second.
You want to second it? We have a second. All those in favor say aye. All those opposed?
Nay.
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 So it's a
Can we
tie?
verify who was the name? Was
Nay.
And
Ed,
John.
John, and Rusty?
And Vanessa.
Thank you.
Following that, I'd like to make a motion that we accept the T. Rowe Price recommendation, or the T. Rowe Price choice for these target date funds as an option to replace the State Street target date funds that Mass Mutual currently carries.
Do it. Second. All those in favor?
Aye.
Aye.
Any opposed? None opposed. Motion carries.
All right, so to move forward to replace the funds, and Julie, you make a very good point, and in the future, duly noted that we will not be a proxy without full committee. Not that I'm on the committee, but just trying to facilitate.
I will start
And
that process tomorrow.
Well, and I agree that these types of questionnaires, it'd be nice to
Yeah.
see it. I mean, after reviewing it, I kind of see where the outcome would be, so it's only 7 questions we look at.
Right,
No,
no,
it's for the committee
You
to
said that
have.
from the beginning.
And I said that from the beginning. I doubted seriously that there was going to, that was my initial comment. I doubt seriously that it would change. However, when you have to go back and you have to explain to a lot of people, you need to explain the decisions and the choices that were made and why they happened. And then if they ask you, well, what part did you play in that decision making? And I get to say, well, I didn't, somebody else did this.
Well,
And then they're
but-
going to look at me and be like, well, excuse me,
But Julie,
we need to
you
replace you on that committee.
got the benefit of seeing some very detailed analysis.
Right.
So,
Right.
Because you're bringing it back to the #1 fund as opposed to the 99.
There you go. Yeah, exactly.
yeah, and so Robert, what's the time frame and the steps involved?
I will start the process
Okay.
tomorrow. I will notify my home office people that I work with. There will be some paperwork that will need to be filled out. I'll get that over to Dan. He'll sign it. Once we get that, we'll start the process. But today, as I sit here, I'd say I'd like to believe within 60 days, this should be
Could we
completed.
move, just on a personal question, could we move ICMA money into Mass Mutual to get into the target?
Just need to set up a meeting with you.
You're,
Yeah.
okay.
There
And
are
keep in mind-
ICMA
Do you have more than one?
Well, you're right.
You can actually have more than one. You can
You
have
can have
both
both.
of them, or
Yeah. As long as you don't go over the maximum.
Some firefighters have Mass Mutual and Nationwide.
And a lot of people have ICMA and
Or
Mass
risk
Mutual as
transfer.
well.
As you do right now.
So there's
A lot of floors,
slots. Yeah,
Not
absolutely.
another
Yeah.
slot, those large platforms.
Yeah,
Or
exactly.
you
Oh, yeah.
A lot of
I tried to
people
just
these
leave
days.
it all that. You're gonna have a lifestyle.
No.
Well, I.
Fred, right here, the copy.
I didn't know.
This one?
Yes,
You want a copy of this?
yes, please.
Okay, this is mine.
Or the whole folder, if you don't mind.
Oh, the whole folder?
Ready? Are we set with?
Yes.
Yeah, here's the folder.
I got a folder.
You're throwing us out.
I'm throwing you out.
Okay, thank you.
See you.
Does anybody else?
All right,
Hey,
Freddie.
Janet, the next time
Thanks,
you come,
Freddie.
you
All right,
bring
thank
the
you.
staff card so I can leave them down in my office.
I have some with me, I can.
Okay, because I'll leave them down in the LBCEA office. Outside.
Banana.
So,
Probably not, because I missed the last meeting.
Okay.
I had a broken leg,
Oh, that's no excuse.
with the surgery, with the surgery.
Sorry, John.
Thank you.
Thank you very much. I appreciate it.
My wheelchair. I finally came to work with it.
Gotta fill out some forms.
It took about 4 weeks, but it was a pain, let me tell you.
I have another one.
Yeah, because I'll put them down in the office.
Perfect, thank you, I appreciate that.
Dave, I'll hit you first.
Thanks, nice.
Thank you.
My way I can follow along.
Do you have an additional one? That's all we have left?
Well,
Let me know just in case.
I'm sorry.
I guess I need to ask if you're gonna.
Julie's gonna issue.
So this is last word.
Leslie?
Nationwide.
I just gave him,
Okay,
here's the, an additional.
okay. Not a bad meeting to close out the week here, huh? Yeah. There. I'd say we're a little behind schedule, so.
Because we're getting better.
That's right. Good point.
audience still have a criminal division.
Oh, I gotta go get my.
No,
So where's Mark on vacation?
All I know is he went to Disneyland
Oh,
with his.
So he's
To
not
work
fishing.
or?
He might be fishing, because he couldn't have stayed there the whole time, right? I don't think he could have been there the whole time, but, so I'm sure he came home and went fishing somewhere, don't you think?
I don't know, he might come in with his ears on.
Well, he's got some little ones that needed to see Disneyland. I know they were telling him all the nice places. I don't think they had the problem though, because they didn't have hot weather, right? There.
10
I was
funds
saying,
on
go in,
March.
it's a small world, it's nice and cool.
10 funds on
It is
March.
nice and cool in there.
Yeah.
Thanks.
I like Mr. Chili Flowers.
Hey, Marshall.
How you doing?
Good, how are you?
Doing well, thanks.
Hey,
Billy?
You guys can
Where should we sit?
Right here.
All right.
Hi,
Good, how are you?
you guys need to stretch at all, or you're doing okay?
I think we're okay.
Yeah, I think everybody stretched.
Going
that
in
was
for a
not
pan.
stretched.
Oh, can I have this?
Yeah. Yeah.
So here's,
Do
who's
we
here
need to
from
make room
Columbus
for
today?
a chair?
I know you're happy, aren't you?
Up by 2.
Yeah, but aren't you happy that it's not 9 degrees? It was 9 degrees there this morning in Columbus.
Yes, it was. and it snowed yesterday.
Yes, it did.
Well, I'm sure there are some UNLV
I
fans in
was
here.
just thinking more.
Are there
You're
UNLV
playing
fans?
now, sort of.
Yeah, I'm an Aztec alumni, so you know I don't want to. I'll just leave it at that.
The Rebels win today, they're going to play San Diego.
That's right,
State.
again, yeah.
And New Mexico. So,
Yeah.
so,
Yeah.
well, you know, we're running a little bit behind, so this is nationwide. Marshall Goff, Julie Miramontes, and I'm sorry,
Jason Smith.
Jason Smith, thank you, from Columbus, Ohio.
Yes.
All right, well, thanks for being here. We'll start with the fund review. So on page 8, here's our executive summary, and from last quarter, there's actually 10 funds on the watch list out of 28 that are in this particular plan with Nationwide. And as it is right now, from my understanding, this is 100% firefighters. Is that correct? Okay.
Yes.
All right. So 10 funds here: American Century Heritage, American Funds American High Yield, American Funds Capital World, BlackRock Natural Resources, Nationwide Aggressive, Nationwide Conservative, Nationwide Moderate, Dreyfus Appreciation, and then on page 9, Oppenheimer Value, and then Goldman Sachs Midcap. On page 11, there's the asset classes and the funds that are in the plan. And then on page 12 is the performance summary for the quarter. That out of these 28, 3 funds were in the highest quartile, 2 funds in the top third, 2 funds in the top half, and then 6 funds in the bottom half and 14 in the bottom quarter. That's just for the bottom quartile for the fourth quarter. 7 funds beat their indexes, 20 did not. And the fund highlights T. Rowe Price growth stock are again at large cap growth. One of the best performing category was up 11.86%, top 14th percentile. That's great. Nationwide growth up 11.34%, top 25th percentile. And then on page 14 is the plan composition. And, you know, a couple interesting things to look at when you look at, in the bond category, you got the Eaton Vance Build America bonds, less than $16,000. You know, that might be, again, an area where we may be able to trim. Is everybody familiar with the Build America bonds, what those are? Interesting thing.
Built this building.
Yeah, from my experience, I'm going to say that came, and I may be wrong, but maybe about 12 years ago they were incepted, and what they are is they're issued by municipalities, but they're not tax-free.
Mm-hmm.
They're higher coupon municipal bonds that are partly subsidized by the federal government. And there was a big launch, a big, you know, hoopla about them, but I really don't hear that much about them, you know, broad spread. It's just interesting to see a fund made up of just those bonds in a defined contribution plan.
So would you like some history behind that?
Sure.
Okay, so the history behind that is Nationwide has an endorsement relationship with the International Association of Firefighters. And as such, about 3 or 4 years ago, we went and met with President Shakeberger and the council. And what they were looking for was a place where firefighters could use their retirement money that would get reinvested back into the cities that they served. And this was one of the investment options that would allow them to do that, because the money would go into buying the Build America bonds, get reinvested into buildings like this. Great, it was a great program. Actually, the Build America bond program stopped about 1.5 years ago, 2 years ago. And so no new Build America bonds can be issued. And actually, Nationwide is looking at pulling that out of the lineup. So.
Okay. Okay, now, just, I guess I have to mention, if you mean you may not offer it going forward, or would you unilaterally make the decision to pull it out as planned?
So what
or?
we would do is we would be sending a letter to the city, making some changes to the product. Now, as the plan sponsor, the city has the opportunity to either accept the changes or reject the changes to the product.
Okay. Okay.
So we would just be changing the product.
Okay. All right, and then on page 16.
On page 14 is the Nationwide Alternatives Allocation A. Is that number in thousands?
Yeah, what's that, Marshall? That $100 million?
$49.
What is that fund?
So the Nationwide Alternatives Allocation Fund is a fund that is made up of different asset classes, most of which are not in the core program. So you have emerging market stock, emerging market debt, TIPS, or Treasury Inflation Protected Securities, international bonds, real estate, and commodities. And it's a fund that's intended to be a diversifier to a normal portfolio.
Not a whole lot of people using it.
Not a whole lot of people are using it.
Very astute.
Yes. Nothing gets by. Nothing.
Yeah, and
Checks
then
everything.
on page 16, under stable value, there's only, $3 million in your fixed account. Can you confirm, what is the crediting rate right now?
3.3, I believe it is right now.
3.3.
Mhm.
Okay. And is there a floor on it?
The floor is, what is the floor? 3 1/4?
Should be 3 1/4.
3 1/4.
Okay. Okay, so total assets of $26,377,910. Okay, now on page 20, here's our scorecard detail. And let's first acknowledge the 10 funds that are on watch. American funds, high income, that's the high yield bond fund, junk bonds, if you will. 82 and 59 respectively. Last quarter it was 74 and 69, so worse on the 3-year and a little better on the 5-year. That would remain on watch. And then you've got these asset allocation funds. The Nationwide Conservative Fund is on watch, 88 and 96 respectively. Last quarter it was 89 and 93, so not a whole lot of change. That would stay on watch. And then the Nationwide Moderate Allocation Fund is on watch, 64th and 84th. Last quarter it was 65 and 74, so fade a little bit on the 5-year. That would remain on watch. And then the Oppenheimer Value A was on watch, and 90 and 36. Last quarter it was on the 76 for the 3-year, so it got worse, but it got a whole lot better on the 5-year. So, presumably that would stay on watch for another quarter.
What was the 5-year last quarter?
68.
68,
Yeah.
38, 36.
Some quarter dropped off there.
Yeah. And then the Dreyfus Appreciation Investor Fund, that's on watch, 77 and 86 respectively. Last quarter it was 77 and 70. So same on 3-year, got worse on 5-year. And on page 21, you got the nationwide aggressive Jason, what fund is that? Of the large blend? Is that?
The Investor Destination Aggressive, so it's
Yeah.
part of our risk-based fund suite.
Oh, okay.
The way that it's, actually, we made a change to it a little earlier in the year. It was 95% stock, 5% fixed income, which put it into the large cap blend category.
Okay.
And we've changed the allocation to scale it back to 90-10, which will throw it in the aggressive allocations category. But it's going to take a while for Morningstar to recategorize it because they use a rolling time frame.
Okay. And so it's been on watch. It's in the 86th percentile, 79. Last quarter it was in the 81st, so it slipped 5 percentage points on the 3-year. It was on the 68th, went to 79 on the 5-year, so that remains on watch. And then moving on, Goldman Sachs mid-cap value, 66 and 60. Last quarter it was 56 on the 3-year and 51. So that's gotten worse. And then American Century Heritage, 75 and 59. Last quarter it was 64th and 51st, so that actually got worse as well. And then on page 22, American Funds Capital World was on watch. This for fourth quarter, 48th and 70th. Last quarter on the 3-year it was 67, so it got a lot better, and it was 68th on the 5-year, got a little bit worse. And then the BlackRock Natural Resources, 80 and 54. Last quarter it was 77 and 53, so it got a little bit worse. The question I had, and this is for the committee to consider as well, and so, you know, with Nationwide, we just got done, and we're replacing the State Street, suite of target date funds. They're 2, and through is a better option, and they rank very low, so we're going to replace those. And when I look at these funds, of the 10 funds that are on watch, a lot of them are within the asset allocation suite of funds. You've got your conservative, moderate growth, aggressive growth. And so those kind of come as a set, right?
Mm-hmm.
So just so the committee knows, if at some point in subsequent quarters, if you wanted to replace one, they all seem to be kind of ranking poorly together. And so you would theoretically replace all of them with a different suite of asset allocation funds. And in doing so, please understand you won't be offending Nationwide, because they're open architecture. They'd be happy to take a different suite of funds as long as it meets their revenue requirements. So I just want to make sure everybody understands that. So, but anyway, would somebody like a motion to keep these 10 funds on watch?
I have a question before
Yes.
we do that.
Uh-huh.
Nationwide Growth A.
What page?
It's going to be on page 21 in this book. In December, it was 74 and 44, and now it is 79 and 56. It was not on the watch list prior.
No.
So I suggest that we put it on the watch
Yeah,
list.
yeah, and yeah, that's a good point, Julie. First, I want to just anchor down and make a motion
okay.
to keep. But no, that's a very good option. Then we would go back through and see if there's any additions.
Okay.
For sure. So.
So do we have a motion?
Motion to keep the 10 funds on the watch list that we had last quarter.
Do you have a second?
I'll second it.
All those in favor?
Aye.
Any opposed? None being opposed, motion passes.
Okay. And then staying on the scorecard detail, as you go down this list, as Julie noticed, the Nationwide Growth A should be added to the watch list, as it's below the 50th on the 3 and 5 year. And that would be it.
Judy, do you want to make a motion?
Yeah, I make a motion that we add the Nationwide Growth A to the watch list.
Second.
All those in favor?
Aye.
Any opposed? Motion carries.
All right. And again, on page 26 is the performance of all the funds that I've gone through. And I'll tell you, it's not very stimulating reading, but
It is for Jason.
Hey, I'm all over it. I'm all over
that's
it.
right.
I was going to say, if I can interject one thing real quick.
Yeah.
So the nationwide risk-based suite of funds, does have some challenges when you compare it to the peer group. But if the board would ever like additional information that could offer some levels of explanation as to why some of the peer group comparisons may or may not be appropriate, we're happy to come in and kind of give you a little bit deeper dive into those, kind of pull back the curtain and show you what's underneath.
I would think so, yeah. Are they equity light compared to categories?
Yeah. So like the conservative, the category goes all the way up to 50% in equity, and our fund is 20% in equity on the conservative.
Yeah.
So if we take a look, for example, I know you've got Sharpe ratios in here. If you look at the Sharpe ratios of the funds compared to the category, on a risk-return basis, we actually look very good. That's one of the things that we really try and target with those risk-based funds is that if somebody chooses the conservative fund, we want to make sure they're in a conservative portfolio. And when you do a peer comparison, we've struggled with the same thing, showing it in our reports that we put together as well. But showing a peer comparison against a fund that's 50% equity in a rising interest rate or a rising market,
Yeah.
you're going to significantly underperform. So
Yeah.
I just wanted to throw that out there. If that's something the board desires us to come and bring some information on in a future meeting, we're happy to.
I would suggest that before any fund is deleted from the lineup, that we get that feedback.
Sure. Yeah. It's the categories. It's a like I mentioned, it's an imperfect world, but the comparisons are imperfect because within, like as Jason said, within a category, one conservative fund isn't the same as another conservative. Different, degrees of conservative.
Sure.
If these are actively managed funds and you have a fund category that allows you to invest up to a certain percentage in a rising market, shouldn't the investment advisors identify a rising market and B, allocate more of the portfolio to a stock percentage rather than saying, well, I'm going to sit in 20 and use that as an excuse when I underperform?
Sure. So to answer that question, the risk-based funds, they actually overweight the way that they handle risk more so than return. Because if you're an investor and you're buying a fund with a very low standard deviation, and the fund manager starts to overload on equity to chase return, you're also increasing the risk, such that if the markets turn on you and you get some sort of a geopolitical event, that conservative investor is now in something that looks moderately conservative or moderate. So they're actually very disciplined about staying within their certain risk parameters so that we don't go beyond that.
Now, Jason, what would you say, and that's a fair statement for somebody that's in the conservative fund, and this is just
No, please.
This is just a collaborative discussion. But what about if somebody is electing a growth allocation fund and they're not getting 400 basis points upside as another suite of aggressive funds?
Sure.
So
and that's something that when we bring the information in, we will try and bring some comparison information. Because the other thing is, in terms of these categories, some of it is comparing against other suites of funds that are risk-based suites of funds where you have a conservative and moderately conservative. Other ones are just balanced funds, for example, like an Income Fund of America is going to be up to 70-75% equity, 20%, but it's a standalone fund. So these Morningstar categories don't break out suites of funds versus individual funds that are in the different categories. But yeah, for example, like the aggressive allocation falls underneath. Part of that is due to the allocation to bonds. Part of that is due to an international exposure. So international markets over the past 3 and 5 year time frame have dragged domestic markets, but that fund is about 35 to 40% allocated internationally. And so again, those are just not excuses necessarily, but reasons why on a peer comparison to a large cap blend, which is going to focus like on the S&P 500, something that's totally large cap domestic, which is outperformed an international market when you're comparing a fund that's 40% international or 35% international to it, it's going to be underperforming.
Okay. All right, so if nobody has any more questions or comments, we can move on from the fund review to any nationwide update.
Yeah, I don't know how much time, if you guys want to spend, I don't know how much time we have, so I'll just pass these out, and we do these come out on a quarterly basis. This is our gauging success report.
Yeah, and I actually marked
to
do a little accelerated.
Yeah, I'll go through it quickly, yeah. So I know in the interest of, do we need any more?
We have one more?
Yep.
Thank you.
Here, do you guys want one? Okay, so yeah, I know you guys were a little behind, so what I will do is I'll just hit on a couple. We went over this last quarter, so obviously in a span of 3 months, not a whole lot's going to change, but it's important at least maybe to look at a few things because this is the year-end report. This is the December 31st report. So I'll just kind of go through and handpick a few gems out of here, and if you want to look at it later and send me any questions or comments, we can do that. Does that sound good for everybody? Okay. We'll start on page 3. And this is our quick plan facts. Shows us our total participant count is just shy of 400. We had 57 new enrollments in 2013, and the plan assets at $27.48 million. There's about a little over $2 million that deferred in, those are planned contributions last year, and about $3.6 million of rollovers from outside. Could have been IRAs, could have been money from ICMA or Mass Mutual that rolled into the plan. And then you see the assets in our managed platform at 5.2, and there's 76 people in that using that service. That pro account is our managed service. So if you want someone to, if you don't, actively manage. If you don't feel comfortable picking your own funds, that kind of thing. Page 4, we see there's 333 participants actively deferring, and we have 63 inactive. So one of the things we looked at and we did a marketing campaign was how do we get those inactive back into the market? And what you also need to look at is what is that? It's actually a pretty small amount if you look at it versus it's about 15.8% of the total participants, which I do these all the time, and usually I see that number around 30, so it's actually a pretty healthy number. So what we need to do is out of those 63, how many are retired? How many are, maybe some are on leave for some reason. So we took a quick glance at it, and Julie just looking at them.
Retired.
Well, it's just from what you could see. Yeah, so
The ones I knew.
pretty high amount are actually retired, so they're always going to show up in that inactive. So there's maybe only half of those or so that are actually someone who maybe took out a loan and stopped contributing or for whatever reason, but we can do a campaign to try to get some of those back investing again. Let's see, what else should I go over in the interest of, let's go all the way, let's jump a whole bunch here to page 13. Page 13 is going to show you, up at the top there, the average number of assets is 5.1 in this plan versus your peer group, which are plans in our region that are between 20 and 50 million in assets. That's your peer group. There are 30 different ones we're comparing you to. So very well diversified plan. Average annualized deferrals is a little over the peer group, about $6,100, and the average assets just shy of $70,000. And this is actually another telling graph of how diversified most of the investors are. 88.7% of the investors in this plan have 5 or more different asset classes.
That's Julie doing her.
There's Julie. Julie. So if you look at the peer group, it's 53. So only 5%, or 5.5%, only have one asset class, and most of those are probably going to be in the fixed. That's what we normally see. So
Or maybe an asset allocation.
the asset allocation would show up as 5+. Yep.
Okay.
Since they would be invested
Okay.
in several different asset classes.
Good.
And then below just shows you account balance and annualized deferrals by age group and versus peer group. So pretty good, pretty healthy across the board. The 18 to 25 group has a little work to do. Julie needs to go pick on those young ones. Tell them to start
We
putting
don't have a
money
lot
away.
of, we don't have a lot of people that are 18
Well,
to 25.
That's true, yeah.
And most of them don't start in the department until they're 22, 23, 24.
Yeah, good info. So other than that, I don't know if there's anything that's really, changed too much from last quarter or really earth-shattering information. Again, feel free to read through it. If you have any questions, let me know. Be happy to answer those for you.
Boy, there's a lot of loans in Vegas compared to the peer. I guess this has been the epicenter of distress.
It is, yeah,
Yeah.
unfortunately.
I saw quite an increase in loans.
Yeah.
Yeah.
Across all plans. What happens when you don't pay back the loan?
You're responsible for the taxes on it, and it's basically a distribution.
Oh, it's treated
It's treated as a distribution, so, yeah. Any questions on any of that information, or?
It's pretty healthy.
Good stuff.
Yeah.
All right. Well, that's my abbreviated version.
It seems like there's a lot less invested in cash
Yep.
in this versus the other
Oh,
plans.
yeah.
Any-
Mm-hmm.
You want to know what a lot of our guys do? They invest their investable assets in Nationwide and put their fixed assets in Mass Mutual.
because of the
Yeah.
quarters.
They're invested in both plans.
Yeah.
Interesting.
And especially a lot of our older guys that were in Mass Mutual before, they'll put some in Nationwide, but they keep the majority or the bulk of their assets, their fixed assets, all in Mass Mutual.
That is interest
Instead of
rate
getting
is dropping,
3.25,
right?
they get 4.
Well, I think across their whole book of business, it's probably dropping, but they've indicated that 4% stays indefinitely
Oh.
for Vegas.
Wow, that's awesome.
So,
That's why they're there.
Yeah. Yeah.
yeah,
stuff.
so.
Well, I don't have anything else that I had prepared for the committees, unless there were questions you had directed for Nationwide.
Well,
I'll let you get to your.
you can certainly participate in the target date
Sure.
presentation we
Mhm.
have. So if there isn't any other questions about the money flows or metrics, we can move on to the target date analysis.
Would everybody, does everybody find this helpful to bring on a quarterly
Yes.
basis?
I think so.
Yes.
Okay. Great.
Yeah.
Is there another copy in there, Dave? Is that an extra copy? No, of the target date analysis? Okay.
I got mine.
No extras?
Is that what you handed to me?
Yep.
Yeah.
Do you have one for yourself?
Yes, I do.
Okay, then here, Jason, the three of you,
Oh,
you can
thank
share
you so
it.
much.
So-
We're happy to.
Yeah. And we just went over the same thing with Mass Mutual, and so Lake Mason and American funds were not available in the Mass Mutual, but with Nationwide, we're comparing the American funds, Lake Mason, T. Rowe, and Vanguard. And obviously the same questionnaire went into this one. And,
Can I comment?
pardon me?
We beat that to death.
You did. You're
Call
done with
security
us.
on Edward. So you got the four, again, this is, I'm going to get feedback to the software that these pages should really be numbered, but, we're starting here, and, you got the expense ratios. Lake Mason is the most expensive of the lot. But, pretty much what you're going to find is the T row, again, is, looks to be the most compelling. And since the pages aren't numbered, everybody may be looking at a different page, but if something stands out, please ask me and I can answer it or respond to it. But if you go to the second last page, that's, in a nutshell, at least. And again, you can use any one, but I've been comparing just the 2020 across the board.
What was the age demographics that we saw? Where is the majority of our age?
You're looking for, if you look at, let's see.
You're looking at the age one?
Good page. You get 17.
It's on 17?
18, 17 and 18. 17 will give you dollar amounts and contribution amounts.
Oh.
18 will give you the number. I think that's what you were looking for. And so most of them are 36 to 45 and then 46 to 55.
Are you trying to equate that to a target date, a target return?
Correct.
Question for you, Marshall. So my question to you is, in the event that we were to make a motion today to move forward with these time funds, are you guys ready to implement and move forward with that process with any of these funds?
Yeah, excuse me, we're not replacing? I should.
Right, we're
Yeah, you're just adding.
Yeah.
So I mean, are you ready to implement?
Oh yeah, so what we have to do is we have certain release dates. I don't know offhand when those are, but they're typically at the least quarterly, sometimes even bi-monthly. We have different release dates where we can transition new funds onto a plan. So I'd have to check with Home Office and see what that date was, and we could let you know when that is. And then we can do a letter going out to all participants that said, hey, this is a new fund added to your plan, and we could also add some statement messaging.
Yeah.
So I'd have to get you the date, but we wouldn't be able to do it tomorrow and just turn it on. But in a relatively short time frame, we'd be able to make that happen for you.
The interesting thing will be, a year from now, when we look at these reports, how much money is really going to be in these funds, because your asset allocation funds are pretty well sponsored, but these are QDIA, so if somebody had some money go in their plan, they didn't make an affirmative election, it would go into their target date. That's what the qualified default investment alternative is for. But it'll be interesting to see, a year or 2 years from now.
Oh yeah.
Through communication, the work you do, how much traction these funds will actually get, but they're being added just to comply to the QDIA.
A lot of
in the
education,
IPA.
because since it's not a fund that's currently offered, you're going to have go out and explain to everybody what the heck it is.
Right.
if that's the case. I mean, as the other fund we saw earlier that had that option, there was, 530,000 in it.
And they've been in here forever, which isn't that much.
So I think a lot of it is education. People don't even really know
That's right.
what it is and what it does.
Right. And to a large degree, the attraction is simplicity. Somebody can, instead of, taking an asset allocation questionnaire and answering the questions and having some, computer model, regurgitate an asset allocation recommendation, populate with the funds, and build their portfolio up on an a la carte basis, they could just easily pick one. It's just an easy default option, even if somebody selects it.
Yeah, you really by adding target date funds, you'd have 3 different options for someone who's not comfortable doing it on their own. So you already have the asset allocation model. So that's someone who says, I'm moderate or
The
I'm
risk-based.
conservative, risk-based.
Yeah.
And the problem with that is that it might be what you are today, but if you don't change it in 20 years, you're still in the aggressive fund, when maybe
That's
you
right.
should be getting more conservative, it has not made a change for you. So the target date will take care of that. So you start with a target date, and if I'm retiring in 20 years, I might be in the 2025 fund. So it's going to automatically get more conservative for me. The issue with that one that you need to know is not everybody who's retiring in 2025 feels the same way about risk. So he and I may retire on the same day, and I may be real conservative, and he may be real aggressive.
That's right.
So then you have the managed accounts, and the managed accounts, which you pay a separate fee for, will do both. They're going to say, how aggressive are you, and when are you going to retire, and they're going to get it more conservative as you get closer to retirement, and then they're going to give you an annual update on your risk tolerance to make sure you're still feeling the same way about risk. So you've got the full complement of different options for those who don't feel comfortable picking a large cap over a small cap and a mid cap and all that stuff. So
Yeah, and again, it's another indication that it's a highly imperfect world, because you could be 25 and default into the 2055 fund, but you might be really conservative and you're very aggressive.
Right.
A lot of market exposure.
right,
That's why the managed account is so compelling.
right,
But underutilized.
that's right.
Right? So, and I went to a meeting last week. I was in Denver, and it was stated and quantified that people that are in a managed account, having some professionally managed, their returns are so much better than when they do it themselves.
Yeah. Yeah.
So,
I know, it just happened the other day. I was at a station, and a guy that he did his own mock portfolio of what he would have chosen, and he's in the managed service, and he said that he was outperformed by 7%. Pro account outperformed what he would have done on his own by 7%.
how about that?
Yeah.
But you have seen the monkeys picking stocks on
Well, sure,
boards
yeah.
that pick better
Yeah,
than
well,
80% of
stocks
them.
is one thing, asset allocation
Yeah.
is another. We're talking
Yeah.
macro asset
Yeah.
allocation.
If there's no objection, I'd make a motion that we go ahead and have Nationwide implement the target date funds from T. Rowe Price and add that as a new addition to the Nationwide offerings for our membership.
I'll second.
Motion on the floor, how many say yes?
Aye.
Any nays? There being none, motion passed.
Fantastic.
So I'll just need somebody from the city to just send me some instructions. I don't know if that's you, Dan, or we can.
I'll send you,
We'll chat. Yeah, we'll chat about it. But
I'll have, if you need something signed, I'll mark things to sign.
okay, we'll get together on that.
All right, that was efficient.
I know.
We're gonna catch
Travel
up.
all the way from Columbus for that?
I'm actually on my way home. I spent Monday, Tuesday, Wednesday in Northern California.
Okay.
So this was a nice stop on my way back home. And I fly to Phoenix tonight and then catch an early flight in the morning.
All right.
Take the jacket.
Chasing the worm.
Yes.
Right.
Take a
Yeah.
jacket.
Exactly.
That's right.
Yeah.
Hope it doesn't snow. More
It's
tonight.
supposed to be 50,
No, in Columbus.
It's supposed to be 57 on Friday in Columbus. So I'm hoping all the snow disappears by the time I land. Here's hoping.
Here's the hook.
Well, thank you.
Thank you, guys.
We got some more committee stuff to go over,
Yep.
so you guys.
See you,
can-
everyone.
Thank you so
Yeah,
much.
really out.
Stan?
Nice to see you guys. Okay.
Okay, made some changes to the growth fund as well.
Thanks, Freddie.
Thanks,
All
Mark.
right, good to see you.
Enjoy the
All right.
Madden.
Yeah, oh, yeah.
I'll reach
I'll be
out
back
to you
out here
on
next
growth
week.
fund.
Anytime. Okay. Thanks, Julie.
Nice to see you.
All right. Are you going to be at the state?
Yep.
Are you got there? Cool. See you later.
I hope so, I'm the president.
Oh,
I'll be
yeah.
there. If I'm not, that's probably not a good thing.
Are you guys the like the paper record keeper for all those? Yeah, I noticed that.
Uh-huh.
Do we have a record keeper for the committee who keeps like these on a monthly basis or on a quarterly basis?
Well, you guys keep it right.
This is something new that we've taken on. We
Oh.
have not. So
I've got copies of it.
We've been sending electric, right?
Yeah.
So there's certainly an
Okay.
electronic.
Oh, there's a
Yeah.
trail.
See, because we don't attach it as backup because it's not supposed to be for public access.
Yeah. Yeah, I understand.
You know.
The last agenda item is a committee discussion that we have an updated and amended investment policy statement, and it was originally approved with Rusty's input, good recommendations. We added language that includes how do you evaluate and choose and the responsibilities, requirements of the service provider, currently being an ICMA, Mass Mutual nationwide, and also the investment consultant, such as myself. And so if you go on to page, okay, so starting on page 5 is the investment consultant, and Dan, pitch in as you feel fit, but a lot of this, I'd say candidly, was taken from the scope of services that were in, we had something to go off of, and really it was a lot of it, the scope of services in the contract and the services that are covered under, that I'm performing under Morgan Stanley's institutional services agreement. And this is sent ahead of time, but if anybody didn't get it, take a quick read.
Is there ever an advantage of going with an administrator like Vanguard or T. Rowe Price directly, rather than going through and using only their palette of funds offered in that fund family versus having Nationwide, Mass Mutual?
Only their palette of funds?
Only T. Rowe Price's palette of funds in the plan?
Never, because, within the deferred compensation plan, you've got asset classes that range from stable value fund to, maybe emerging market equity and everything in between, and it would be,
Well, Vanguard and T were price offer that pallet.
no, all fund families offer the pallet, but I would submit to you, it would be virtually impossible for any one fund family to have best of class offerings across all those asset classes. Now, and that's why you want a provider that offers open architecture, and not just open architecture with offering a lot of funds, but not trying to corner into mandating, saying, you need X amount of funds with our fund.
With our fund.
Because now, the world has evolved with, it just comes down to revenue sharing, that, each of these service providers have a certain revenue requirement they need to make. And it doesn't matter if you're using their proprietary fund or an outside non-proprietary fund.
And we're obligated to use somebody like Nationwide. The city can't just function as what Nationwide and what Mass Mutual and what...
I don't think so.
No, not unless you want to hire a boatload of people.
Yeah, but once you make the elections, they're sitting in a computer and they get sent off.
Yeah, but there's still a ton of administration.
Good luck with that one, John. But has everybody read the text under investment consultant? And I made reference to service provider, but interchangeably, this is page 6, references plan administrator as Nationwide, ICMA, and Mass Mutual.
How are you compensated, Freddie? Does the city pay you?
Yeah, city pays me. It's a flat fee, and it is it pays Morgan Stanley $105,000 a year, paid quarterly, and that's an aggregate amount between the 3 providers based on the asset size.
Copy.
Yeah. Now some plans have an asset-based fee. So if the plan went up in value, I get, if it was 10 basis points, I get pay increase, and decrease if the plan went down. But it's complies easiest for fee transparency and very clean services provided for a specific dollar amount paid.
Is there any thought to adding a brokerage option?
I believe we need to have more assets in either ICMA or Mass Mutual to do that. I don't think we're large enough. I was going to pursue that with Mass Mutual and ICMA later this year, but from what they told me during the RFP process, the consolidation of both of those plans allowed us to offer brokerage. Without that, they said it were a little small. But that stuff changes all the time, so yeah.
Do we need a motion to approve this, or any more discussion?
I think you need a motion to amend the investment plan.
Yeah.
Is it amendment?
Motion to approve the amended.
Yeah.
To move and approve the amended plan.
Yeah.
So John, are you making that?
Yeah, I'll make a motion to
I second it.
approve.
Hey, wait for you. I know you're getting mad. Do it.
So all those in favor say aye.
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 Any opposed? Motion passes.
I need about 5 minutes of your time. I can do this really quick. A handful of employees have approached me regarding the Roth option of the 457 plan, and it's something that all the plans can implement right away. That's an after-tax option for the 457. However, I talked to our IT people today, and they said, well, we can do it, but it's going to cost maybe $20,000 or $30,000. And then also on the other side of the IT, they said, unless there's about 50 participants, it's really not worth it. So I just wanted to throw that out there. What I'll try to do, and I can do it as part of this Palooza that we're looking at, is maybe bring that up in those sessions and say, who would be interested in this sort of vehicle? So that way I could say, oh, we got 100 people interested, and then go to IT and get it done.
Why don't you do a survey, make IT do the survey, send it out to all the
We
employees.
could do that. We could do that. So there's ways to.
Why don't you do the survey and we'll rely on what you say?
Well, you're right on this, so I'm happy.
It's a quick, just a quick email survey.
Yeah.
Yeah.
Goes
Yeah.
out and with an explanation of what
An
a Roth
explanation of Roth is. Yeah.
is.
So we'll do that.
And I think the agenda did say Roth IRA, you meant.
Yeah, I know, it's
you
Roth
meant
5457. IT yelled at me for that today, so. The other thing we're doing with the plan administrators, all three of them, is we're looking at the people that have not actively contributed. They're going to send a postcard out to them and try to get them kind of contributing again, as well as the 3 account managers will have names of people they can approach. It's in their database. The other thing they're going to do is if somebody has 1 or 2 funds, they're going to approach them and talk about diversification and that sort of thing. Now, sometimes it's appropriate. They might have the target fund or whatever, but they'll take a look at that. So if somebody's all into the general account and they're 28 years old, it's typically not appropriate, right, based on risk and that sort of thing. So they're going to try that as well. So we'll see how that works. And then regarding the Finance Palooza, I'll hand these out. These are very draft. And this is a general announcement that I would put out probably in April. I would change this a little bit. Just teasing people as to what's going on and that sort of thing. I'd actually flip this red explosion thing here with a comic I found that talks about retirement planning and that sort of thing. Right?
I was trying to be funny there.
Then this next piece is basically how would we announce it to all employees with firm dates and that sort of thing. It has to be tweaked for just readability and that sort of thing, but I just wanted to get something out to you today. And then this is very, very draft, but it's a list of topics that we'd like to go over. We would like to have Ken Lamberton here, who's the investment officer for Nevada PERS, and have him do a presentation. Ornella, who's with ICMA, she wrote a book called Moneylicious, and we would like to have her talk about that in terms of people investing for Generation Y, but really it applies to everybody. Tom Axline, who's the CFP for ICMA, he would like to talk about PERS, Medicare, and Social Security. Susan May is not a CFP with Mass Mutual, it's just a name. And we would like them to talk about diversification. John Brown is just a name as well. We have a program with Consolidated Credit. They would come in and talk about credit scores. We're not sure what we would do on that one yet. It will be finalized. And Janet and Ornella, we would have them talk about what's available on their websites, webinars, calculators, and that sort of thing, so we could drive more people there. Freddie had a suggestion for a presentation that might work out here in terms of talking a little bit about the target funds as well as some preliminary what you need to do for retirement planning. Now, what brought this to mind, you're probably wondering, is when we did the Benefit Palooza, I was doing retirement planning, just very global thing. I had the last session on the last day, 4 o'clock on a Thursday. All right, and in City Hall, Council Chambers nobody's going to show, right? It was the most attended session out of all the sessions we had. So I said, there's a need for this. So this is what drove this. We'll do free lunch to the attendees. Some of the plan administrators and stuff might have prizes. So it's just something we want to do. Try to get people to prepare for retirement. 51 is the average age here. And I get too many people in my office that are not prepared, or after they retire, they call me up wondering what they can do. PERS is good, but they're just not ready to retire. They haven't planned appropriately. Other people, they got it nailed. They come in there, oh, I don't need that. They're all set. But when it comes to Medicare or health benefits, the sticker shock is just, they're not ready for it.
Well, my only comment, you guys are going to laugh. Do you really want the word finance in this?
I don't know. It's like I said, it's a draft.
Right?
Well, see, what I'm trying to
It's
do.
an HR thing, and they're trying to drag finance into it.
Well, what I'm trying
I
to
mean, I
do.
know it's
I'm trying,
people away.
no, I'm trying to attract all employees, not just those that are near retirement. So, like I said, this is draft. We have time to play with
Yeah.
this.
No, I
So
wouldn't
it might
scare them
come
off
up-
with that more, but I think that the whole idea of retirement planning.
Do you want to just
know,
replace
it's-
finance with investment, maybe?
Yeah, maybe that would be.
Yeah, maybe. That's a good
That's
idea.
Yeah.
yeah.
Thank you.
I just think finance will go, oh, we want to talk to those dry accountants.
Okay, yeah,
They
we
might
all-
get hung up on that.
No, well, I'll be waiting for you then.
We don't need
another chart
And
for water.
the other question is there a reason why we don't have anybody from Nationwide?
Whether you're knocking
They
on the
don't want
door,
to
or whether you're a
participate,
long way
basically,
away.
because
Yeah.
it's just the
Never
firefighters.
too-
Yeah, the
People
firefighters
from
won't
the
come to this.
Never too late to start planning.
It will be
I thought
videotaped.
that we asked Mark,
Start planning, yeah.
one of the questions that I had asked Mark is about the about us, everybody being able to add Nationwide as well.
Talk to Mark about that.
Okay, I mean, I know that question was asked in our
Yeah.
first meeting, and he said that was a conversation that they had been talking about already.
Not if it goes to Denver or Washington first.
Well, yeah, I mean, I've got 2 slots in there that are, I call open, the last 2, so I could always throw in Nationwide or whatever if they have something
Yeah,
to add.
I mean, I'm just curious.
The other ones I like, the last 2 I can move in and out. That's it for me.
Good plan.
Thank you.
Good plan.
Freddie, one comment, can we get Mass Mutual to do something that, like Nationwide?
Yeah, I was getting ready to ask that question too.
Where they can provide some quarterly
Engagement.
information.
It's like,
This is
because
real interesting.
IMCA did one instead of
It's
Nationwide.
interesting that.
You know what?
The other stuff we got from Nationwide last quarter, with regards to educational stuff that they put out, seemed to exceed what the other 2 processed also. Some of the stuff, the educational stuff that they exhibited last quarter, they brought some stuff with them and gave it to us to show us what they put out,
Yeah.
what they have available, which the other 2 did not, Mass Mutual and ICMA.
Mass
Yeah.
Mutual has given me some stuff through their individual Caitlin. It's probably equal to Nationwide, ICMA as well. A lot of the stuff's on the website, but we're going to start doing these mailers more often, and we're going to target, just like I said, the people
Yeah.
that aren't diversified and the people that stopped investing. And we're going to see how effective those were. And if they're pretty effective, we'll go to stage 2 and see what we can target from there.
Yeah, I would just like to get a copy of this from Mass Mutual, because this is 2 quarters in a row that they haven't provided anything like that in IMCA and
I'll
Nationwide
contact
both did.
Okay.
I meant, as a matter of fact, I was going to contact them after this.
They're
It's
saving
good
every
stuff.
now and
Yeah.
then to keep that 4%.
Yeah, and in this, my personal view, that's the only reason Mass Mutual is still here, because of that great big huge number. People were very upset that we were going to get rid of that they have that 4% guaranteed return, and they weren't
Yeah.
going to get that with either of the other ones.
Yeah. Listen, I just one more comment, just to kind of solicit response from the committee. So, here we are, we're 2 quarters in now, and, you can see how much there is to do and how, long it takes with, $200 million between 3 providers, I should say. And so, we're, moving along, IPS guidelines, we've identified funds that are on watch. We have keeping funds on watch. But which direction do you think the preference to go is? Because if you put a fund on watch and replace it with another fund, then you still have the same amount of funds. And I think that, in the long run, the big picture, you'd be very well served to consolidate and streamline things, because you see what we're trying to do, and it's really very difficult to do it at a high level with the voluminous amount of stuff we're working with. And, kind of going back to, the last year when we, tried to consolidate and, do the RFP, and for reasons, the city council rejected it. And, candidly, there could have been a better job of communicating to city employees, the unions, and not just, blindsided with here's what we're doing. So, lessons learned for sure. But, so here you have three providers. And on the extreme end, close your eyes and imagine a day when you're a committee and we have one service provider. Now, when you talk about all these funds we have in these categories, 3, 4, 5 large cap growth funds, whatever, can you imagine in one swoop, a lot of work going into this swoop, that you have, and Rusty, when I'm talking about the three, I know nationwide with the firefighters sort of out there on the edges of this, so, you can include this in discussion or you can't, it's subjective, but you have all this, and in one RFP, you get people to bid on the aggregate sum, and in one button, you consolidate all this into one plan, something very tight, then you can execute on. To me, that's one service provider, okay? And in doing so,
I'll just set it.
No, it's not. I'm just saying this is collaborative discussion.
Right.
I know.
Okay,
I'll
so
just set it.
yeah, and okay, so on a short of that, at some point, I have a very strong opinion. Let's suppose you never consolidate, okay? I have a very strong conviction that if you were to put Mass Mutual out to bid individually, ICMA out to bid individually, and Nationwide out to bid, not to say you would be surprised at how you could lower your costs and get competitive bids because these providers have been incumbents for so long. Nobody's put their feet to the fire in terms of cost.
So do an RFP for each plan.
That's exactly right. So if you don't want to consolidate, because in doing so, even if you stick with each provider, you get them to rebid and maybe lower your costs. Now I'll give you one example, okay? Is this off the record? Are we still keeping minutes?
Once the meeting is adjourned, then it's off the record.
Okay. Well,
So you did make a motion
So
to adjourn
there's
the
a-
meeting, right?
No, what's the problem with being?
Yeah, I'd say keep it on the
Have it
record.
off the
okay.
record. You
And
have to
so
adjourn.
when I met with, because this is, I'm not saying that is important. It's all very relevant here, I guarantee you. Because remember, your job as fiduciaries is to monitor investments, minimize costs. Okay? When somebody bid on, case in point, when we did this RFP, somebody said, with the bids come in, ICMA said, well, we have, let's call it 40 million. If we were to win the whole 150, our revenue requirement goes down to this. Quantifiable, 8 basis points, whatever it is, okay? Well, when Dan and I were in a meeting with Nationwide, and they said, our revenue requirement, they said it point blank, is 45 basis points. And on some of the share classes, okay, because when we looked to shop the retirement date funds, some share classes only reimburse them 30 basis points. So therefore, they would have to charge an additional 15 to meet the requirement, okay? Now, one of the funds, their revenue requirement's 45 basis points. One of the funds reimbursed them 50. I said, okay, where's the other 5 basis points go? And he hemmed and hawed, because in a real situation, that excess revenue can either be credited back to participants' accounts, go to a budget account to pay qualified expenses, whether it's a consultant, auditors, whatever, or you can shake one of these vendors down and try to get them to offer lower, cheaper share classes so that it's revenue neutral. Okay? So, you've got these incumbents that when they won the business, it was never said what their revenue requirement is, because I guarantee you, if they were to win a new piece of business today through a competitive process, they would make it very clear what their required revenue is. And that's the point I'm making, that if you really want to do your job as fiduciaries and minimize costs, there's still a lot of work to do in that regard. I'm just trying to be the best consultant I can be for the city. So, And like I said, there's so much to do, and you don't have to answer it, but just, just keep it in mind that there's a lot of improvement. I'm pretty certain about it. Even if you didn't want to consolidate, Rusty, and if at any point in time you wanted to put these, people out to bid, it's a lot of work. I'm willing to do it, but in doing so, even if you retain these providers, you get them to rebid, and maybe it would cause them to lower their costs, even if you kept them. So, somebody want to make a meeting, motion to adjourn the meeting?
All right, motion to adjourn.
And I guess we have to second that motion?
Second.
We went up to 5 o'clock, so.